which proposes a review of the achievements of MIFID II regulations. Let me start on a personal note, which I think illustrates the evolution of this key EU legislation. The first time I heard about MIFID was in January of 2005, when I joined the CNAV, and I attended for the first time a CSER board meeting where the advice on level 2 of MIFID I was being discussed and approved. Back then, some discussions were actually quite similar to nowadays. Transparency, liquidity, systematic internalizers, best execution, and so on. In these 16 years, many things have changed. Of course, not least the market structure and the way securities are traded. Then came the inception of Esma in 2011, MIFID II in 2014, its level 2, in which I was also deeply involved, and its most recent review 3 years ago. If we look back now, these 3 years seem like such a short period in this overall context. I think we can affirm that MIFID II has allowed a very notable improvement in transparency in the markets, better and more homogeneous information received by the investors, and greater knowledge on the part of the clients. It has also made it possible to adapt the original MIFID regulation to a new environment and evolution of those markets, allowing greater accessibility to these markets for society as a whole. MIFID II has had a positive effect on the European markets, with 4 areas, in my opinion, where the regulation has had the greatest impact. Firstly, an improved level playing field between markets and the participants. MIFID made a significant change in the structure of financial markets in Europe, especially in the area of equities. However, MTFs and systematic internalizers, even when providing comparable services to regulated markets, were in practice subject to a less stringent regulatory and supervisory regime under MIFID I. MIFID II rectified several of these imbalances and set a level playing field of renewed competition between trading venues that has benefited the customer. MIFID II has also addressed the risks to the orderly functioning of markets posed by the growth of algorithmic trading and high-frequency trading. These firms which engage in algo trading are now subject to stricter organizational, testing, and control requirements. In addition, the new electronic trading regime has made them more resilient and better equipped to ensure orderly trading. And as a third element in this first block, in derivatives markets, most of the trading of standardized OTC derivatives has moved already to trading platforms as a consequence of the creation of a new market category, which is the OTF, and the derivatives trading obligation through MIFIR. With respect to commodity derivatives, MIFID II position limits and transparency rules try to address price volatility and to help prevent market abuse in these types of assets. Secondly, let me also highlight as a positive impact, in my opinion, a renewed twist to investor protection rules with new product governance tools, the possibility to ban certain products for retail investors, and reinforced conflict of interest policies, including the inducement regime and the one on financial advice. Thirdly, I would highlight the new transparency regime for fixed income markets and derivatives. MIFID II established for the first time a set of EU transparency requirements and has accelerated the transition towards electronic execution for fixed income markets. And fourth and finally, although this is frequently overlooked, MIFID II, together with EMIR and CSDR, has removed a significant number of barriers to cross-border competition between trading, clearing, and settlement infrastructures, allowing access between trading venues, CCPs, and CSDs. But beyond the benefits and positive impacts that the MIFID II regulation or the directive under regulation has had on financial markets, which you will discuss throughout this two-day conference, there are still areas for clear improvement that ESMA and CNMV are working on. I would like to point out some of these. For instance, the quality and cost of the data, as well as the improvement and the usability of the comparability of the information that is being disclosed under the MIFID regime. We need to tackle also the difficulty in accessing post-trade information on a real-time basis and involving the full range of equity instruments through mandatory contributions, improved OTC data quality, or other mechanisms. And in this respect, I support the setting up of a true post-trade consolidated tape for the EU. We probably need real incentives for market access for small and medium-sized enterprises beyond the current figure of SME growth markets introduced in MIFID II, to promote their liquidity on the basis of common and harmonized conditions, to foster investor confidence, as well as the promotion of cross-border listings in the medium term. We need also to consider improvements in the functioning of OTFs. The concept of the multilateral system and the scope of the trading platforms need to be possibly rethought. With regards to the transparency of stock markets, equity markets, it is also necessary to reflect on the double volume cap as a mechanism to limit dark trading, thereby reducing its complexity, and to clarify the scope of the trading obligation with regards to third country shares in a post-Brexit world. When it comes to fixed income and its transparency regime, ESMA has already published a number of proposals with the aim of simplifying and making what is now an overly complex regime more efficient, thereby promoting harmonized implementation of that regime across the European Union and ensuring greater transparency for market participants, in particular for derivatives and bond markets. In terms of regulatory reporting, CNMV supports ESMA's suggestion to simplify reporting while improving data quality, data comparability, and usability. And finally, a set of proposals is also underway to simplify the commodity derivatives regime by making it more efficient for market participants and competent authorities, and above all, to avoid the excessive scope with which it was defined at level 1 in MIFID II. When it comes to investor protection rules, we probably need a resetting of the inducements regime towards a fully harmonized way. It would also be wise to further streamline the information provided to clients, like the one on best execution or the one on costs and charges. In general, I am a big fan of regulations over directives in areas like this one, and I think that some contents from MIFID II could be included or moved towards MIFIR. Ideally, when we see each other in another conference in 3 years' time, we would be speaking only about MIFIR. These, and surely many others, are the issues that will arise during this two-day conference on one of the fundamental pillars of the regulatory architecture that underpins our financial markets. An essential part of the economic recovery of the European Union and its companies in the current uncertain times that we are living depends on its robustness and its continuous improvement. I do not want to end this introduction without thanking all the panelists and participants in this conference, as well as the CNMV and IE teams that organized it. I hope, therefore, that it would be to your liking. Thank you very much.
Thank you very much, Chairman Buenaventura. We are very pleased with your presentation, the support that, of course, I know, but we all know that the CNMV gives to this conference and also, and in general, to any discussion and any research done on MIFID in order to improve whatever aspects of it might be. Well, good morning, afternoon, day, ladies and gentlemen. We are very happy to welcome you here in this exciting conference on MIFID II 3 years later. I want first to thank presenters, discussants, and panel participants for their willingness to share with us their research and views. I also want to thank you, this large audience. We are extremely pleased to see that there are so many of you from all around the globe, and we thank you for your support in being with us today. MIFID II, as Chairman Bonaventura has already brought, very largely explained, as we all know, came into effect 3 years ago, after many more years in the making. And it has had the effect of changing noticeably the environment in which financial markets and its participants operate. It has introduced new rules, changed some, and why not say introduce new restrictions? Of course, the kind of thing that nobody likes, but that they are here and they are always present in any sort of legal rules or regulations. In particular, among many things, it has changed the way in which trading in markets is conducted, and the relation between market intermediaries and their clients and providers. Academia has been and is playing an important fundamental role in that it tests the effects of new rules and conditions, helps compare with previous or alternative setups, and in some helps legislators or us regulators fine-tune regulation to make it adapted to the role that society expects financial markets play in the economy. This is the case of this exceptional panel of researchers that we have with us today and tomorrow. As for today, devoted to the effect of MIFID II on markets, in particular trading mechanisms and conditions, we have first Christian Westheim from University of Vienna. Christian is a researcher, is an assistant professor of finance at the University of Vienna, also affiliate at the Leibniz Institute for Financial Research, has had previous positions in other universities as Mannheim, visiting scholar in Hong Kong and Sydney, and his claim in relation to this session, his main research interest is microstructure of equity markets. Christian has worked on research projects in cooperation with the stock exchanges and national international financial regulation. I don't want to make a spoiler of what he's going to say, but just want to mention the first sentence in his abstract of the paper that he presents and in which he has worked together with Thomas Johan, Talis Putins, Sachit Sagat, that says, on paper, quasi-drug trading, the effects of banning dark pools in a world of many alternatives. And just the first sentence is already very enticing. What it says is, we show that quasi-dark trading venues, i.e. markets with somewhat non-transparent trading mechanisms, are important parts of modern equity market structure alongside lit markets and dark pools. That's already very enticing. It tells us already a bit of what it's going to say. His paper is going to be discussed by Roberto Pascual from the University of the Islas Baleares. Roberto has a PhD in economics at University Carlos III of Madrid. He teaches financial economics and financial markets. He teaches in several master programs in international recognized schools. And his main area of research is financial market and microstructure, covering topics as high-frequency trading, hidden volume, liquidity provision, and price discovery in order-driven markets, limit order book dynamics, and circuit breakers, the whole menu. I will now give the floor to Christian, and immediately after, just with a half-minute break, I without any further ado, give it to Roberto Pascual to give the discussion. Okay, thank you very much. Christian, the floor is yours.
Okay, thank you very much for the kind introduction. So, as already suggested, this is joint work with Thomas Johan, Tarek Budnitz, and Sajid Sagade, and Sajid has recently moved to industry, so the usual disclaimer applies. So this is purely an academic paper. So this is about the European equity markets, and as the title suggests, there are many alternatives available, and so just as an introduction, I'm showing you here an overview of the various kind of venues that are available in European markets. So we place them in a two-dimensional system alongside a third dimension, which is multilateral versus bilateral trading venues. So we have venues with various degrees of transparency, various degrees of available immediacy, and then we have the distinction between bilateral, which is SI and OTC, and the multilateral markets. And so this paper deals with the question, what happens if we remove one of these kind of markets? So how market participants respond, where do they trade, and what's the impact on the exchanges? So to give you a brief introduction about dark pools, specifically in the context of the European markets. So they rely on the reference price waiver or the large scale waiver to be allowed to be non-transparent. And so the former, the reference price waiver, is the one that's kept according to these double volume caps. So market participants, of course, when they decide whether to trade in dark pools, they face a trade-off between, on the one hand, having cost savings because of executing at the midpoint. So European dark pools that use a reference price waiver, they execute at the midpoint. And to avoid information leakage because of the non-transparency. On the other hand, investors who use these venues follow immediacy. And there are various concerns among regulators, market participants, and also brought up by academics about possible excessive use of these dark pools. And the first concern, and probably the most relevant one in the European context, is that dark pool usage or too much dark pool usage may impair price discovery. And so these regulations then were motivated by the fact that, well, in between the introduction of MIFID and the introduction of MIFID II, there was a large increase in the aggregate use of dark pools in the European markets, as you can see in the figure here that is displayed here. So MIFID in general has 4 pre-trade transparency waivers that allow the avoidance of pre-trade transparency, and as suggested, there are 2 that the dark pool use. Reference price waivers and large scale waivers. However, these aren't the 2 that are limited by MIFID II. What's limited is reference price waiver and the negotiated trade waiver. And so when discussing the results, we will mostly interpret them in the sense that trades in small trade dark pools, that is those using the reference price waiver, have been prohibited. We're not really going to discuss what the impact of eliminating negotiated trades is. So I think maybe there's generally not such a good understanding of what this part of the double volume cap limit affects in market outcomes. So the double volume caps are called double volume caps because we have 2 caps. One is 4% of total trading volume accounting for by these two waivers, reference price and negotiated trade. And the second one is 8% for all venues combined under these waivers. But in fact, almost all cases are those of the latter rule. So it's very rare to have one venue accounting for 4% if the second rule, 8% in total, isn't also breached. So we focus here on those breaches that affect this 8% rule. And well, if this breach happens on a 12-month rolling basis, then such a stock may not be traded under these two waivers for the next 6 months. And so we have, well, discrete dates where from one day to the next, dark pool trading, or at least dark pool trading using reference price waivers, is eliminated for a given set of stocks. And 6 months later, for most of those stocks, it's possible again, and not for all, because these computations of the rolling 12 months are repeated every month. So a given stock may remain suspended for more than 6 months. So as I suggested, we have 3 questions that we will try to answer. The first one relates to where does trading volume move? And then we answer the question whether there are implications and what the implications are on market liquidity, market efficiency. And for these questions, we use the most relevant market. So this shows the timeline of the various events towards the introduction of the double volume caps. And in the end, the final date is when the first bans 6 months after the introduction are lifted. One important aspect here is that while most rules under MIFID II that affected the markets applied from the beginning of January 2018, because of data quality issues, ESMA decided to delay the application of the double volume caps. So those applied only from March 2018. And so we're able to separate the effect of the double volume cap from everything else that changes at the beginning of 2018. So every month we have the publication by ESMA, and a few days later we have the application of the ban to the set of stocks that had breached this 8% limit. And so we will look at the initial event in March 2018, and then we will look at the event 6 months later when a large number of bans were lifted. So we use the already mentioned ESMA DVC reports. So from those, we take the amount of trading under the different waivers, the relevant competent authority, and the trading volume as certain variables that we use in our empirical analysis. Then standard stock market and firm level data from ICON, and then we use trading volume under the different trading mechanisms from Fidesz regulator and block trades from Fidesz block trading reports. So there's some data cleaning in addition to this data, so we don't use this data in raw form, but that's basically what we start with. And for measures of stock market liquidity on the most relevant market, and we use Refinitiv tick history, trade and quote data. And in addition, tick size bands from ESMA, because they may contribute to the explanation of what we find. This is what our sample looks like. So we look at both liquid and non-liquid stocks. So for the liquid stocks, it's apparent there are proportionally many more suspensions than for the non-liquids. And there are also important differences between countries. So this already suggests that if we want to look at the effects of a ban we shouldn't confound this with country-specific trends over time that may deviate between countries in Europe. The non-liquid stocks that we use, they are not all non-liquid stocks, but we use those that traded at least 5 million euros in 2017. So we end up with about 600 banned stocks in the liquids and about 200 banned stocks in the non-liquids. And altogether, we have 2,400 stocks roughly in our sample. This gives you an overview of the data. So the liquids basically start from size of a few hundred million euros up to, of course, the largest European firms. The non-liquids are, of course, in a much smaller range. And you see trading is much more fragmented in liquid stocks than in non-liquid stocks. That's the Herfindahl index of the market shares of the different venues. And among liquid stocks, these two waivers on average sum up to 8.9%. And these figures are from before the ban applied. This means, of course, a very large number of stocks were banned among the liquids, and those are this treatment in March. So 53% of the liquid stocks were suspended. In September, 45% were be available to be traded under the waivers again. So the difference is those that had an extension of the suspension because of the very large volumes under the waivers that they had. Among the non-liquid, there's far lower proportion of the trading under the waiver. And therefore, we also find that the proportion of stocks for which the suspension applies is also much smaller. So it's about 2% of the non-liquids that get banned here. The bottom of the table shows you the liquidity measures. On the left-hand side, the liquid markets. These are all pretty liquid, not only category liquid. Of course, spreads and other measures are much larger for the non-liquids. So before actually looking at a formal analysis, I'm showing you here a few plots of simple difference and differences, meaning we take the change in this case, the market share from before to after the event for those that are banned and subtract the change among those that are not banned. So obviously, the share under the dark reference, under the reference price waiver, has to drop to 0 among those that are banned. And you see that a drop by almost 5%. These figures are from 4 weeks before the ban until 4 weeks after. So these 12-month rolling numbers will have been larger for these stocks because otherwise they wouldn't have reached this 8% limit. But we always compare 4 weeks before to 4 weeks after to see the change that is actually the result of the ban. And after 6 months, you see almost a complete reversal. And the real reason why it's not a complete reversal is that those that are available to be traded under the waivers again after 6 months are those that didn't have the highest waiver percentages. So those that had the largest amount of trading under the waivers, they still are not available to be traded under the waivers again. And so that's why this increase in September is a bit smaller than the decrease in March. What you also see in this figure is that if you look at the weeks before the ban, these two groups of stocks, those that in the end get suspended and those that don't, they don't really move perfectly in tandem. So it's unclear whether these control strokes are really suitable for formal analysis. And so formally we test this, and we find that the assumption that there is no difference in the pre-trends is violated here. So that's why this is just descriptive and not really the final analysis. When the trading under the waivers is banned, proportionally the largest increase we see in periodic auctions. All stocks before the ban, or all groups of stocks, whether they in the end get the ban or not, had less than 1 percentage point of total trading volume in periodic auctions before. And you see the large jump for those that do get banned. What you also see that there's a long-term development where there's a further growth months later, and it's not perfectly clear to us whether that is a long-term causal effect of the ban or whether there are other developments that may explain why more market participants began using the periodic auctions. It's also a long-term trend among the non-suspended stocks, so this is not obviously attributable then to the DBC. And you also see in the end almost complete reversal. Yeah, so the level after it is larger because there was a long-term trend. But if you compare the 4 weeks before after each event, and you consider that the stocks that are having the lift of the ban in September had a lower waiver percentage initially, then this is really almost a complete reversal of the initial effect. And we have the same for non-liquid shares. So those are, first, they are fewer. Second, they have of course, smaller trading volumes. So that's why everything that you see is a bit noisier, but the picture looks, in the end, very similar to what we have for the liquids. So that's the reference price waiver. That's periodic auctions. While you see huge fluctuations, but this is really due to the thin trading volume among this group of stocks and the fact that this group of stocks itself is smaller. Nevertheless, you see a strong increase in periodic auction usage, and this continues in the medium term, and we also see the reversal after the ban. So it appears that it's not the case that after using the periodic auctions that market participants had learned enough about or learned to appreciate the periodic auctions enough to use them instead of dark pools. When dark pools became available again, it was for certain purposes, again, the preferred choice by market participants. Okay, so let's go briefly to our more formal analysis. So we had these violations of the parallel pre-trends, which means we shouldn't really completely believe all details of what we just saw as causal evidence. The effects on market shares, they are so clear that they're not going to be affected by such violations, but the subsequent analysis effects on liquidity, on market efficiency, they might lead to spurious results if we don't adjust for these different characteristics of stocks that are treated, that is, that are banned and that are not banned. So we predict a ban using propensity score matching. So we predict the probability of a ban using dummies for each country, each major index. Then we include the price, the market cap of a firm, the relative tick size, and the tick constraint. So how often does a stock trade at one tick as predictors of the ban? And if we do that, and then match one stock that is banned with one that is not banned, we see that those two groups much better move in parallel in the pre-trend. So we're willing to believe the results after doing this matching, whereas we're more concerned if we do simple difference in differences. use another matching approach, not shown here for brevity, but the results are very similar if we match on market cap and the reference price waiver volume in the weeks before the ban. So in the weeks before the ban, that allows us to still get stocks that are similar. Of course, the waivers themselves, since they are determinative of the ban, we can't use the 12-month waivers percentages. But if we match by market cap and the previous few weeks of trading under the waiver, we also get good matches and, well, what we believe to be credible results in the end. So we use 4 weeks before and after. We always exclude the first week, that is when the ban applies, and the first week when the ban is lifted, to allow for some adjustments. Yeah, I'm not going to show you the test for the parallel trends, but we found no violations in our main analysis after doing our matching. And in the end, we also look at interaction effects to see whether effects may differ based on stock characteristics. So this I'm going to skip. So I'm going to show you figures for the main unconditional causal effects that we find. So those are the regression coefficients based on our propensity score matched difference in difference estimator. So you see the 4 weeks before, it's really stable. There's not much variation. And then you see the large drop. Well, of course, this is reference price waiver figure. So this is what you expect to see. And we see near complete reversal afterwards. The periodic auctions, they also look similar to what we had earlier with simple difference in differences. So we see an increase by about 1.3%. And a decrease by almost 2% upon the lifting of the ban. So with this better matching, we also there look at other value types. And so you see this is systematic internalizers, and there's little effect, if any. So it's not very precisely estimated, but if there's any effect, it's not very large. So investors don't seem to move towards SIs upon the ban. OTC, where there are large fluctuations from week to week, but the average is not significant. So when I say OTC, I have to say we have combined all off-book trading here, whether that is reported OTC or reported as an off-book trade on exchanges. Lit markets, so that's presumably where volume should have gone according to the preferences of those favoring transparency. So we see while at the very beginning there's no increase, there is some increase up upon the ban afterwards, and in the end it's well, less than 2 percentage points on average an increase, which means that's less than half of the reference price waiver volume that has been eliminated. And we also see a reversal when the ban is lifted. So the reversal is of similar magnitude. So again, if dark pools are available, those who had to escape from dark pools and chose lit markets instead, they apparently moved back to dark pools. There's no significant effect on the usual exchange auction markets. And we have the same thing for non-liquid shares. So of course you see the elimination of reference price waiver trading upon the ban. The increase when usage of the waiver is possible again is a bit smaller than for liquid shares. And that's probably because there's more random fluctuation in usage of these venues for these non-liquid shares. Periodic auctions, we again see larger fluctuations for these non-liquid shares, but nevertheless, there is a significant increase in their usage from near zero to some substantial number when the bans apply, and these volumes reduce again when the ban is lifted. SI, we don't really see any substantial change. Off-book, well, of course, it's noisy. OTC generally, or off-book trades generally, are not noisy category. Depends on what trades are reporting under the category. And for non-liquid shares, it's even worse. So that's why, well, some coefficients may look large, but they're not significant statistically because of this noise on the data. There seems to be a huge increase in OTC after the ban is lifted, which is a bit surprising, and maybe we shouldn't read too much into that. Lit market usage increases upon the ban and decreases again when the ban is lifted. Auctions, nothing there. And so now we look at the cross section. So we have seen the average effects. The question then is, do some stocks trading volume move to different kinds of venues than is the case for other stocks? What we see that, for example, the tick size may play a role here. So if the tick size is relatively large, there's an increase in volume in the periodic auctions upon the ban. And we see some weak effects of the tick constraint, but overall, there's not really very much to see. So it's hard to find good predictors of changes in the cross-section of these market shares. For the lifting of the ban, it's very similar. So I'm not going to go through these coefficients. Time isn't there anyway. For non-liquid shares, again, most of the interactions are non-significant. So let's take the remaining time to look at liquidity effects. So we see what looks like a decrease in quoted spreads after the ban and increase when the ban is lifted. Though this is, well, the magnitude is pretty small. We'll see a bit later in the table, but the magnitude is certainly less than a basis point. And for effective spreads, the picture is similar. Changes in market depth at the top of the book, that is, are not significant. We look at the price impact, so price movement within 60 seconds after a trade. And there's no really very clear result, maybe a slight tendency towards reduction upon the ban and increase later on, but it's not very strong. Realized spreads are basically unchanged. For non-liquids, we see very little change, and generally these non-liquid results are so noisy that unless something is very statistically strong, we shouldn't read too much into this. So here, there's a lot of noise in there. We see small changes in both directions in these coefficients, so let's not read too much into this. And there are some cross-sectional differences, but yeah, we don't have the time to go into the details here. But then generally, the results are on the liquidity are very weak. This is for liquids, this is for non-liquids. For efficiency, we use variance ratios, meaning the variance of the 60-second midpoint returns relative to the time-adjusted variance of 300 seconds midpoint returns, and you see very little here. So it doesn't appear, according to these standard microstructure efficiency measures, that there is any effect or any substantial effect on price efficiency. In return autocorrelations, the picture is pretty similar. So I'm just going to click through this. There's little effect. So let me conclude. So we see when the ban applies to these small dark trades, which are those under the reference price waiver, we see some change in volume, some increase in volume in lit markets. Proportionally, periodic auctions gain a lot more. So they seem to be the close substitutes to dark pools. And this is especially the case for large tick size. The reversal causes pretty much the opposite effect of the initial ban, as expected. For liquidity, there's no significant effect on average. There are some differences between large and small firms. Large firms, liquidity is a bit reduced. Those of smaller firms is slightly increased, but the effects are not very large. And we see no effects on price efficiency. So the major conclusion is that if there are many alternatives available that are close substitutes, then well, eliminating one kind of trading venue may not reach the goals of moving the trading towards more transparent venues, which of course was a goal of the double volume kits. There's a related study that finds consistent results by looking at institutional investors. So they show institutional investors actually move their volume from dark pools to periodic auctions when there is a ban. And they find similar correlations with transaction costs for dark pools as they find for periodic auctions after the ban, and no aggregate effect on transaction costs. Finally, of course, further developments post our sample period. So there's this restriction of off-tick trading in SI since sometime in 2020. Probably someone's working on a study there. We're not, but probably we'll see effects of that published somewhere soon. We have the ongoing discussions of reference price trading in periodic options. And of course, as already alluded to in the introductory remarks, the possibility of increased dark trading in third countries. That's another concern that needs to be considered when analyzing possible consequences from what we've learned about the double volume caps. So thanks a lot, and I'm looking forward to Roberto's discussion.
Thank you very much, Christian. As I've already introduced Roberto, I will just, without any further comment, I will give the floor to him. Thank you.
Thank you. Good afternoon. Hopefully you can see my slides now. Okay, so let me first thank the organizers of the event for inviting me to discuss this excellent paper. From an academic perspective, I have no doubt that this study contributes to our understanding of modern fragmented financial markets, in which trading mechanisms with different levels of pre-trade transparency coexist and compete. Let me start with a quick overview of the paper. The authors use the implementation of MIFID II double volume caps mechanism to study what happens with the distribution of trading and with market quality when restrictions are imposed on only one form of dark trading, in this case, relatively small trades in midpoint dark pools. The authors find that when the ban is effective, volume migrates mostly to quasi-dark mechanisms such as periodic auction markets and systematic internalizers, and much less to lit markets, suggesting that the quasi-dark markets work as close, albeit imperfect substitutes of dark pools. As a result, the ban has no significant impact on market liquidity and only causes a slight deterioration in price efficiency. Now, that traders are willing to look for alternative ways to conceal their order flow when the darkest platforms are banned should not come as a surprise, at least not for fans of the Star Wars saga. We all know that you cannot resist the dark side of the Force, right? Indeed, I think that one of the most important questions arising from this study is whether dark trading or dark liquidity is inevitable in today's financial markets. Now, here is the fact. European exchanges were far from fully transparent way before the original MIFID came into force back in 2007, and therefore, before dark pools were an actual concern to anyone. So, for example, there are studies from the pre-MIFID era showing that 45% of the limit of the book of the Paris Bourse used to be hidden, and 80% of the limit orders submitted were iceberg orders. For the Spanish market, there is evidence that 80% of all the trades for the stocks in the official market index involved hidden volume back in 2000. In this slide, you have a picture of the current situation in Europe after MIFID. The table shows that sophisticated traders, algorithmic traders, seldom hide the limit orders on Euronext Paris, while less sophisticated traders, the non-algorithmic traders, still hide 10% of the orders. This significant change in the likelihood of hiding on a primary European exchange suggests that, at least for sophisticated traders, hiding off exchange is not a close substitute for hiding on exchange. This was theoretically predicted by Degrees and others in an unpublished paper that I think that the authors of this study should consider citing. The situation of Europe at the beginning of the century resembles the situation today of the National Stock Exchange of India. According to the World Federation of Exchanges, the National Stock Exchange of India is the fourth market in the world by number of trades. In a recent study, Chakrabarty and others showed that in this electronic, technologically developed, order-driven market ruled by algorithmic trading, 40 to 50% of the depth at or near the best close of the book is hidden. Moreover, all trader types, high-frequency traders, agency algorithmic traders, and non-algorithmic traders hide orders in this market to a greater or lesser degree. In India, there are no dark pools, and the market is barely fragmented. So in this context, there is no other way of hiding than hiding in the lead. Europe post-MIFID, however, differs from the current situation in another highly fragmented environment, the US. As you probably know, in the US, there are more than 60 dark pools operating nowadays, and recent estimates attribute about 40% of the market share to off-exchange dark markets. However, it seems that many traders still prefer to hide in lead markets. Using data from the NASDAQ from 2008 to 2010, so post-regulation NMS, Chakrabarty and others find that 30% of the NASDAQ book is hidden near the best close during ordinary days and 50% during high volatility days. They also show that both high-frequency traders and non-high-frequency traders hide. So these differences between Europe and the US lead me to ask what I know is an uncomfortable question for any empirical researcher. So Christian, I know you are not going to like this one. Do you think the European experience that you examine in your study can be extrapolated to other trading landmarks, particularly to the US case? Now, the authors of this study stress that their findings highlight the need for a broader approach to transparency regulation in modern markets, one that considers the many alternative forms of quasi-dark trading. In general terms, I agree with their vision, but at the same time, I am curious about what do they exactly suggest the market regulators should do about that trading. I think that the paper and the examples that I have shown before suggest that there is an inherent need for hiding in financial markets, and that banning all forms of off-exchange dark trading may not ensure full transparency, since investors could still have the option of hiding in the lead. Of course, banning both on-exchange and off-exchange dark trading is also an alternative, but this option may have unintended consequences, according to the literature, such as lower overall liquidity due to higher adverse selection costs, intensified backrunning of institutional investors' orders by opportunistic high-frequency traders, lower incentives for information acquisition by fundamental traders, and so on and so forth. So that trading seems to me a problem without a straightforward regulatory solution. I also wonder if there are better regulatory options than just banning that trading to shift market volume back to the transparent platforms. Just as an example, the Securities Exchange Commission has been considering for some time now the possibility of introducing a trade at rule in the US. In broad terms, this rule will prevent price matching by a trading center not displaying the best market price by the time the incoming counter-assigned order is received, therefore effectively forcing opaque platforms to offer significant price improvements. Rosenblatt Securities once predicted that this rule will reduce the volume in dark pools. Consistently, in a recent study by Chakrabarty, Cox, and Upson, they examined the effect of the tick size pilot program on volume migration. And they find that the trade at rule, which was imposed on certain stocks in the pilot program, caused mostly uninformed volume to migrate from dark pools to lead markets. So I guess that other options than banning are possible. Christian and his co-authors also find that after the ban, most of the dark volume migrates to periodic auction markets. I wonder if this is really a bad output for the MIFID II regulation. It is generally accepted that price discovery happens during auction periods. So it is not evident to me in which way finding that volume migrates to these platforms after the ban is necessarily at odds with the MIFID goal of improving price efficiency. Moreover, the theoretical literature argues that continuous markets reduce the ability of liquidity providers to reprice stale quotes before they are picked up by fast traders. As a remedy, the literature has proposed to replace continuous trading with frequent batch markets. Finally, if the frequency of auctions were relatively high, even at ultra high frequency, that is every few milliseconds, the loss in transparency, in my view, will be minor. Finally, I have some specific questions or comments for the authors. The first set of questions refer to methodology and data. Now, part of the data used in this study, in particular the trading volume per type of venue, comes from a non-official source, from Fidesa. So I missed some discussion in the paper about how that data is generated and how reliable it is. After all, we are talking about relatively small variations in the market share across trading platforms of a maximum 1.3% or so. Regarding market quality measurement, the authors use intraday data from the, and I quote, most relevant market for each stock. So I wonder, how do they define relevance here? By market share, price discovery contribution, average liquidity level? Are we talking about the listing markets? And how much of the 1% increase in volume in lead markets after the ban that you report goes to this most relevant market? The point is that you construct several measures of liquidity and price efficiency based on the trades and the quotes of this single trading platform. According to the descriptive statistics in the table 4 of the version of the paper that I have read, the volume share of the most relevant market for the median stock and day in the sample is about 28%. So this suggests that a significant fraction of the trading activity and potentially price discovery is happening outside this most relevant market. Would not be better to build metrics based on consolidated trades and quotes? I know, too much to ask in the European context, talking about transparency, right? But still, is there any concern that using data from a single platform may be biasing your market quality analysis? Trading costs are measured by the effective spread and its components. I think this effective spread is a valid measure to examine the impact of the ban, the trading cost of relatively small investors or relatively small market orders. But perhaps the authors could complement the analysis with a metric that could be more appropriate to measure the execution cost of relatively large orders by institutional investors, such as the implementation shortfall. A minor issue but I think is important when it turns to measure market quality is how do you assign direction to trade? This is something that is not explained in the paper. Now, some empirical studies suggest that dark trading is only detrimental to market quality beyond a given threshold. I wonder if the 8% cap imposed by MIFID II on dark pools could be below that detrimental threshold for European markets. Have the authors considered this possibility? And could this explain why they don't find a significant effect on market quality? At the end, we know very little about the motives of the investors that redirect their volume to the quasi-dark pools or quasi-dark markets after the ban. Are they uninformed or informed? So perhaps an analysis of the contribution to price discovery of the different trading platforms before and after the ban, in the spirit of the paper of Chakrabarty, Cox, and Upson that I have mentioned before, could help in this regard. Finding that after the ban on dark pools, which enhances to some extent transparency, price efficiency falls, is not an easy to digest result. So what do the authors think is the channel behind this shocking finding? And now a suggestion. The authors report that stocks from certain markets are more likely to be banned than stocks in other markets, and that the likelihood of being banned also depends on stock characteristics. I think that examining what lies behind these cross-sectional differences could merit a research paper on its own. Finally, my last comment is something the author seems to be currently addressing. In the version of the paper that I have read, the focus is on the initial ESMA reports. So I was curious about whether the findings persist over posterior reports. In particular, what happens with market shares and market quality once the ban is lifted? This has already been shown in the slides. Are there abnormal returns out of the announcement days for posterior reports? What happens with the stocks that are repeatedly banned? Are there spillover effects to non-banned stocks? And a significant fraction of the stocks affected by the ban are listed at the London Stock Exchange. Thinking about the post-Brexit European Union, I wonder if your findings will persist if you also implemented Brexit in your sample. And that is all I got. Again, congratulations to the authors. This is an excellent piece of work that I recommend everyone to read. And I really look forward to see the new version of the paper the authors are working on.
Thank you very much, Christian and Roberto. Well, I have to say, I think it was Christian. It was a brilliant presentation, and Roberto made correspondingly brilliant discussion. I believe Christian might want to respond to some of the questions or comments. And at the same time, I have here a number of questions, so far 4 questions that have been put to either Christian or both of you. So Christian, if you want to start responding to Roberto's questions, I would appreciate that, and then we will give way to the questions.
Sure. Thanks a lot for the great discussion. So many points to address, so I will have just to choose, otherwise we will take too much time here. So are periodic options bad? Well, first, I'm not saying the dark pools are bad. So what we do is we consider whether the regulations achieve their goals. And so we're not saying that we necessarily take the regulator stance, nor do we say that we take the opposite stance. So this is purely an analysis of the effects of the given regulation on market outcomes. Periodic options, are they bad? Well, we know from other markets that do use or have used repeated auctions, that those work well. So a new study by, I think by yourself and co-authors or better, about Taiwan. However, this is different from a fragmented market where you have many continuous venues running in parallel to such venues. And so I think this is one important difference, that there's, well, basically arbitrage opportunities between continuous markets and these auction markets compared to a market that is consolidated in a frequent batch auction. Another detail is probably how much transparency these periodic auctions provide. So the largest periodic auction market in Europe provides information only once two sides have matched. And so if the aggregate market share is of this venue is 2%, let's say, then compared to the whole duration of the trading day, the transparencies, they are really only for a very small part of the day. Data quality, well, we did a lot of cleaning of the data and checked most of the data we could confirm from Fidessa via subsets of other data sources from tick history where we used individual transactions. We need to reclassify some transaction volume between continuous market and exchange auction markets. That's what we did in between the version that you had and the next one that we hopefully finalize soon. So that was one major challenge to get this right, but this should be okay now with the current results that we have. Consolidating order books. It would be nice if we could rely on all exchange clocks being synchronized. So given the frequent updates to order books, well, I think any result that relies on integrating order books in the European markets is at least questionable. So you will always, you will often see crossed order books, but they may not really actually be crossed. And it's just that the clock on one exchange may be 1 millisecond behind the others. So that's why we don't attempt to consolidate order books. Generally, measures of liquidity and are highly correlated between exchanges. So that's why we don't have great concerns there. Trade direction, we identify precisely based on quote updates. So we precisely see the delta in the order book that is resulting from a given trade. So these data contain exchange timestamps. So this should be 100% correctly signed. Is the 8% cutoff too low? Possibly. And of course, we can look at the cross section, but the number of stocks that actually have more than, way more than 8% under these waivers, that's not too large. And nowadays, of course, it's even impossible to study something like that, because as soon as there's 8%, there's a cutoff and there's a suspension. So in principle, we would be interested in finding these differences, and that's why we also use these interaction effects. But given the small amount of stocks that have very high percentages, it's just probably not enough data to find something of interest there. There are more questions, but maybe we should turn to the audience's questions so that there's time left.
Okay, I have, so far I have 4 questions, and I think what I'll do is I'll start with the shortest one, and then I'll leave a long one for the end. The first question, I guess, is for the two of you. It says, dark pools hurt the small investors and benefit large institutional investors. Do you share this view? I think what I'll do is I'll read the 4 of them, and then you decide to answer in which way you want to do it, okay? So the second question is, that's for you, Christian. Did you estimate whether during the ban trading was moved to other types of waivers not subject to double volume cap? Still question. Why the concern about hidden volume? As soon as this hidden volume trades, market participants know volume and price anyway. And the fourth question, wait a second, please. Sorry. Okay. It seems that you are identifying hiding volume with a bad market practice, and maybe you should question yourself why such mechanisms are used. The real interest of every investor is price discovery and minimize market impact. So the question is not related about hiding volume, but about how an investor can interact with as much liquidity as required without having market impact and price slippage. And maybe don't you think that the problem is precisely the market fragmentation itself and not how the investor use the tools they have available to navigate in such a mess of decentralized pools of liquidity? Okay, so these are the four questions I have for mostly Christian, but I think the two of you can sink in and answer. Thank you.
Okay. Well, first about other waivers, we look at the large and scale transactions. So these block trades reports, and we see a small and not very strong increase upon the ban. That was one of the results in our market share analysis. So it appears to be the case that possibly some investors aggregate transactions that they would have otherwise done on reference price waiver dark pools and trade in larger size under the large and scale waiver. We don't look at the order management waiver because I think economically the usage of this waiver is somewhat different. And it's also very hard to get accurate data about this. So at least I wouldn't know for the entirety of the most important European markets how to obtain data on the, essentially it's the iceberg volumes that are executed on these various venues. So I agree also with Roberto that using these orders, so these partially hidden orders, which are those commonly used in the European markets, can be an alternative. Well, it's certainly not as non-transparent as a completely hidden order, and completely hidden orders we don't have in European order books as opposed to the US markets. But yes, looking at these iceberg transactions is something that we could in principle do, but not at a large scale of the entire European market that we've used here in the study. Regarding the last question, yeah, as I indicated, I'm and also my co-authors, we don't take a strong stance that all dark trading needs to be bad. And of course, initially, when dark pools were created, the purpose was for block transactions. And I think very few people disagree about the utility of having dark pools to match large natural participants. So the question is, what is the contribution of small trades in the dark as opposed to moving those to other venues? And yeah, and I think the answer to that is still out there. So it's not the case that we or generally the academic literature also take any clear stance on that. So there's of course many academic papers that I didn't cite in my presentation, including the next one that's going to present it here on dark pools. But there's no one clear direction of results that would say this is bad or this is good. What was the question about? The third question? The
third question is why the concern about hidden volume? And it says, as soon as this hidden volume trades, market participants know volume and price anyway.
Yeah, the question is whether you know that you can trade against someone beforehand. Of course, post-trade transparency is important, but I think post-trade transparency without pre-trade transparency, it's a big gap. So you can't only rely on post-trade transparency.
And do you want me to read again the fourth question, or?
This was about, wasn't it about why we think it's bad that people try to hide their orders?
It seems that you are identifying hiding volume with a bad market practice, and you should question yourself why such mechanisms.
Yeah, that's what I addressed. So basically, well, especially for block trades, there's certainly good reasons to use dark trading, and for other trades, it's just less clear. So we're not taking either direction in terms of, we're not trying to mobilize, we're only trying to analyze data.
Okay. So
if those were the questions by the audience, then of course there's still.
So far I don't have any more questions here, but I wonder whether Roberto would like to step in.
I generally agree with Christian answers. I just wanted to add that about the first question, that whether dark pools are good for large investors and bad for small investors. I think that is a very simple way of putting the problem. I think that, for example, in the US, many small orders by retail investors are either internalized or are sent to dark pool for trading. I don't know exactly know the numbers in Europe, but this is the case in the US. So many retail investors are also benefiting from the dark side of trading, not only large institutional investors. The mod is obviously, if we're going to dark pools, by the different types of traders are not the same. And these are maybe issues that have also have to be discussed too. I mean, is the problem the dark pools themselves, or the problem is the reasons that move the traders to choose to send the orders to the dark pools? I mean, why are they moving away from the lead market? So this is an inspection of the costs and the risks and the problems that they face when these traders trade in the lead should be also carefully analyzed and regulated, in my view.
I mean, this is not a question from the audience, but I mean, from our own perspective as regulators, I guess this last comment, but in general, brings the question. So what is it, what do you think, just being a bit demanding on our side, what do you think is wrong, or what do you think should be addressed or changed with respect to all these issues in any new consideration of the revision of MIFID II? Is there anything? I mean, does this lead you to propose something, or to maybe propose something that would improve the situation?
And maybe not directly related to this paper, and not necessarily relying on one study, but what we've seen with the new tick size rules under MIFID II, I think generally the rules follow a good principle by using this more than one dimension to choose tick size. But it appears that there was an increase in spreads because the ticks divided by spread, the number of ticks on average per spread has been chosen pretty low by the regulators. And if the tick size is large, of course, it's also another reason not to trade on the exchange, because spreads might be artificially high, and you might be able to save trading at the midpoint in the dark as well, if the tick size is too high, so that the spread is often constrained.
Roberto, do you have any concluding remark that you would like to make, or do we just leave it here?
Well, just answering your question. Institutional investors have been complaining for a while on them being background or front run, or whatever you want to call it, exploited by opportunistic high frequency traders in markets. The way they had to face the activity of these opportunistic traders before dark pools were there was or one of them was hiding in lit markets. Now they had the opportunity to go someplace else, and they go because this alternative offers a higher degree of opacity. So the question or the issue here again is, should we pay attention to dark pools, or should we pay attention to opportunistic high frequency traders' actions?
Okay. All right. Thank you very much to the two of you and to the audience that has put all these questions. Our next speaker, actually, Arianna Dumitrescu, is going to present a paper which, it's looking at a different side of basically the same topic, but also with very interesting conclusions. And for the benefit of a good comprehension before the presentation, I would like to briefly read without doing a spoiler of what she is going to say immediately after, but it's very illustrating a part of the abstract that she has in her paper, which she has written together with Ana Bayona and Carolina Manzano. And it says, this paper examines what the paper is called Information and Optimal Trading Strategies with Dark Pools. This paper examines the competition between two trading venues with different degrees of transparency, an exchange organized as a limit order book and an opaque dark pool, in the presence of asymmetric information. We show that the addition of a dark pool that competes with an exchange not only increases traders' strategy set, but may also induce trading venue substitution, a change in the order type, and an increase in market participation compared to when the dark pool is available. Wow, this is quite a strong proposition. The author, one of the three authors of the paper, Arianna Dumitrescu from Lysaght Business School, she's an associate professor of finance there, and her research deals with market participants' strategic behavior and the role of information in investors' decisions with applications to market microstructure, mutual funds, and corporate finance. She has published in Journal of Corporate Finance, Banking and Finance, and Financial Markets, among others. And she's been for many years director of the Group of Research in Economics and Finance in ESADE, and member of the Board of Directors of the European Financial Market Management Association. She's going to be, her paper is going to be discussed by Andrea Baduva at the Universidad Carlos III de Madrid, whose research is centered on market microstructure with a special interest in fragmentation, trading halts, and non-fundamentally driven trading. Andrea is now currently visiting the Toulouse School of Economics and collaborating with Sophie Moinas. In the past, she also visited, we had the honor at my commission of having her visiting the research department at the CNMB, which I'm proud to head at this moment. Without any further ado, please, Arianna, can you give us your wise comments on that very enticing paper?
Hello, everyone. Thank you very much for such a nice presentation. And thank you very much for including the paper on the program. So as explained, I'm going to talk about the role of information asymmetry in financial markets and in the competition between dark trading, between the dark pools and lit markets. As probably everyone knows, in the last 15 years, regulation such as regulation NMS in 2005 in the US and the MIFID regulation in 2007 in Europe increased the fragmentations of the financial market by accelerating the number of alternative trading venues. Some of these venues being opaque venues that do not have pre-trade transparency, and they are called dark pools. The growing importance of dark trading, of dark pools as alternative trading venues, more than 12% of the trading volume in the US is traded in dark pools, and more than 6% in Europe, created a very important concern for the regulators on what are the effects of the dark trading on market quality. In 2015, Commissioner Luis Aguilar claimed that the proliferation of these exchanges and dark traders didn't seem to harm the investors, at least not by any measurable degree. Our motivation comes for the paper comes exactly from this increasing concern of the regulators about what is the effect of dark trading on price discovery process, and also on market volatility, on the segmentation of the order flow between the two trading venues. And this problem is a quite important problem, and the regulation in 2018, as everybody already knows, MIFID II regulation came in place with the aim to increase the transparency of the financial markets and to curb dark trading. As Christian already explained, instead of having this effect, we had a substitution between the venues, and the limitation of the dark trading was not necessarily very successful. As a response to this, in 2020, Esma decided to make a consultation paper which was asking for feedback from the market participants. So they were showing that although the market liquidity benefits from this double volume cap mechanism are positive, they are somehow limited. And it seems that there are a lot of critiques coming from other market participants, from regulators and asset managers and other market participants, especially the one from the buy side, that they claim that the benefits of having this mechanism are not compensated by the implementation costs of this cap. So as Rosenblatt Securities shows in a survey that they executed, there is a disconnect between the policymaker and the industry participants, especially on the buy side, on key market structure reforms. And one of the important questions is, what is the effectiveness of the double volume mechanism? As BlackRock replies in this consultation paper, in the feedback of the ESMA consultation paper, they claim that there are fundamental questions about the effectiveness of the double volume cap that should be addressed before considering small changes or refinements to this regulation. In July 2020, as a result of this feedback and this consultation, ESMA proposed to remove the trading venue cap of 4% and to decrease the EU level threshold from 8% to 7%. So as you can see here, this problem is a very important and very complex problem. And we believe that this problem is quite complex, mainly because traders, they have to take a strategic decision on whether to supply or demand liquidity in the lit market or in the trading venue. And these decisions are affected. One of the important factors in this decision is the information that the traders might have. So as asymmetric information plays a fundamental role in the price discovery process, we are going to build a model, a sequential trading model with long-lived asymmetric information in which we have traders that are rational and they can decide whether to supply or demand liquidity and whether they do it in the lit market or in dark pools. So what we do in this model is to try to understand how the information, how an information shock or information received by the informed traders will affect the trading strategies, the decision to supply or demand liquidity in the lit market, but also how these decisions will change when there is an alternative trading system as a dark pool where traders might decide to go for execution. So what we are going to do is to understand how information affects the decision in the liquid market, how this will affect the decision of the traders to go to the dark pool, but also how this decision fits back in the financial or in the lit market, in the limit order book, in order for the investors to change their trading strategy. So what I mean by this is that the information that of the trading strategies that we have initially in the lit market or in the dark pool market will provide other market participants that previously didn't have any information, will provide them with information. So the prices that the uninformed traders will see in the limit order book will give them information about what is the liquidation value of the asset. They will disentangle this information from the trading strategies of the informed trader in a previous period. So this problem is quite important because it will allow us to understand what is the segmentation of the order flow and how this segmentation of the order flow is going to change after some of the information owned by the informed traders is going to be released in the market through prices. So a short review of our results. We show that adding a dark pool alongside an exchange in general decreases the expected price informativeness. So both in the initial and the subsequent period, the price informativeness decreases, with some very specific exception when the probability of informed trading is extremely high. We also show that in general, the profits of rational traders, they increase, that initially the liquidity traders are not affected, but this in the subsequent period, we might have both an increase or a decrease of the profits of the uninformed and the liquidity traders. And we are mainly concerned about having this decrease of the profits of both the uninformed trader. And we'll show that this increase or decrease will depend crucially on the stock market characteristics. So these cross-sectional differences in the stock market characteristics will have important implication for the segmentation of the order flow in the lit and in the dark market. And as a result, it will have important implication for liquidity, for the volume of trading, and for the profits of the traders. So in order to do this, we build a theoretical, to study this problem, we build a theoretical model. Of course, we are not the first one that look at this problem. And this shows that the important is very complex and also very important. There are several papers that look at the competition between a dark pool and an exchange when the exchange is organized as a dealer market. So these 4 papers, they look at the effect of adding a dark pool or a crossing network with a dealer market. There are other two papers that look at the competition between the dark pool and the limit order book. Butirindi and Werner that is a paper that is very close to us. Well, we are very close. We are extending this paper because we want to understand the role of information asymmetry. In this paper, we do not have Butirindi and Werner. They do not model. There is a symmetric information setup with private valuation. And we are extending this paper by looking at something that we think is very, very important in this decision of supplying or demand liquidity, which is the information asymmetry. Another paper that looks at the competition between the dark pool and the limit order book, it's Broley, that considers information asymmetry, but he looks at, he doesn't look neither at the decision of supply and demanding liquidity, and they do not take into account this effect of the information dissemination through prices. So what we do is to try to understand how information asymmetry affects the decision to supply or demand liquidity of all the market participants, and how this information is going to be to affect dynamically these strategies, the strategies of the investors to stay in the limit order book or to migrate to the dark pool. In order to understand, to solve this problem, we build a very kind of sophisticated model in which we model risky asset, which has a liquidation value V that can take two values, high and low. And this asset can be traded either in an exchange or in a dark pool. The exchange is modeled as a limit order book that is fully transparent. So all the information in the limit order book, it's available to all the market participants at any time. We have the initial limit order book. It's populated by at least two prices on each side of the book. The depth is, initial depth is equal to 1, and it's governed by price and time priority rules. The dark pool is typically agency broker or exchange-owned pool. It's completely opaque in the sense that an order submitted to the dark pool is not observable to anyone but the trader who submitted. And we assume that anonymously, in the dark pool, the orders are anonymously matched, and there is a variety of sources of non-displayed liquidity. This means that we assume that there is an execution probability theta that is exogenously initially at t equal to 1, but it will change endogenously depending on the decisions of traders to trade or not in the limit in the dark pool in the initial period. We have three types of traders in our model. There is an informed trader that has information about the liquidation value of the asset. We have some uninformed trader that the only information they have is the information that is public, so the information in the limit order book. And then there are some liquidity traders that are trading in the market for liquidity needs. Since liquidity traders, they trade for liquidity needs, they need to ensure execution, and as a result, they are going to demand or supply liquidity by using market order in the limit order book. However, informed and uninformed traders, they will choose their decision whether to supply or not or demand liquidity in the limit order book, or to go to trade in the dark pool or simply not to trade based on the information each one has. The timing of the model is the following. So first, the nature draws the liquidation value of the asset at t equal to 0. Then at t equal to 1, a trader arrives. If the trader is rational, informed or uninformed, he observes, he looks at the information he has, and based on this information, he chooses what is his optimal strategy. If the trader is not rational, he's a liquidity trader, he trades according to liquidity needs. At t equal to 2, we have a similar situation. We have a new trader that arrives. If he's rational, he chooses his strategy based on the information set. And if he's a liquidity trader, he trades according to liquidity needs. Now, one important difference is that in the first period, the uninformed trader has information about the limit order book, but this information doesn't reflect any additional information about the liquidation value of the asset. However, at t equal to 2, since he can observe the prices, how the limit order book change, he can infer from the prices in the limit order book information that it is revealed through prices by the trading strategy of the informed trader. As a result, he can learn and he can use this information contained in the prices in the limit order book by in choosing his optimal trading strategy. Now, one singularity of our model is that we assume that if one order was submitted initially at t equal to 1 to the dark pool, this order might go to the dark pool, and if it's not executed, it's going to bounce back to the lit market. So there will be a trade-off between executing in the dark pool and get the price improvement, and wait and come back to the lit market with the risk that the market will move against us. So at t equal to 2, at the end of t equal to 2, if the dark order was not executed in the dark, will return to the exchange. And finally, in the last period, the liquidation value is made public, and any order that it was not submitted and not executed at t equal to 2 is going to return this. And the trading game is going to be over. Now, we are going to try to understand what are the possible strategies that investors have when they choose to trade in the lit or in the dark market. So when there is there is a single venue, only the lit market exists, when the traders have the possibility to trade in the lit market, in the limit order book only, there are 4 possible equilibria. I'm going to talk only about 3 because one of them is obtained for very particular cases of very extremely unliquid and very extreme volatile market. So it's an example that we think in practice is very unlikely to happen. And we are going to obtain 3, well, the example that I'm going to show you are going to be 3 equilibrias, and these equilibrias will depend crucially on stock market characteristics. So for example, will depend on what is the market volatility and what is the probability of informed trading in the market. So when the volatility is relatively low, we obtain that the informed traders, they decide to supply liquidity in the market, in the limit order book, and the same will happen for the uninformed trader. So the first 2 represent the strategy of the informed trader, and the second 2, the last 2 will represent the strategy of the uninformed trader. When the market volatility is high, for relatively low values of probability informed traders, we have that the informed trader decides to demand liquidity in the market, while the uninformed, they will decide to supply liquidity. And when the probability of informed trading increases, so the adverse selection problem increases a lot, the strategy of the uninformed will change to no trading. So since they do not want to face the uninformed trader, they will practically consider that it's optimal not to trade. What happens when there is dark trading? Well, it depends on how big is the execution, how risk in the dark. So if the probability of the execution in the dark is very, very low, we are going to obtain a situation similar to the case of a single venue market. So the investors will prefer to stay in the market and they will behave as the dark pool wouldn't exist. However, as the probability of the execution in the dark increases, we see migration of investors from the dark pool to the from the lit market to the dark pool. And this migration will depend on the execution probability, but it will depend again on the stock market characteristics. Now, one interesting result that we obtain is that in the equilibria possible with the dark pool will in the initial stage, in the period, the initial period, will be such that there is segmentation of the order flow. The informed traders, they are going to trade in the dark pool, they are going to migrate to the dark pool, while the uninformed traders, they will prefer to stay in the lit market. So initially, because the limit order book doesn't provide them with any information, they prefer, the uninformed traders, the adverse selection problem for them is quite important, so they prefer to stay in the lit market. So there is no migration of the uninformed traders initially. However, in the subsequent period, when they learn information from the limit order book, when this adverse selection problem is reduced, they might decide to stay or leave, depending on what they think the information of the informed trader is and what is going to be their strategy. Now, one important result that I think I want to show you, and because it's quite important, is that the migration of the informed traders to the dark, it depends on the stock market characteristics, it depends on the volatility, and it depends, of course, on the execution risk that I have in the dark. But what is interesting is that this the threshold for which traders, these informed traders, decide to migrate to the dark depends on the stock market characteristics. And this has very important implication for the implementation of the double volume cap mechanism, because stocks with different characteristics, with different volatility, with different liquidity, with different adverse selection problem, they will have different level for which of execution risk that they might determine them to migrate or not to the dark. And of course, as initially in the previous presentation was explained, the having a single cap for all the stocks might create a situation when this cap is binding for some stocks, while it's not binding for the others. Another interesting result that I want to point you is that we have, for example, this situation that when the volatility increases, most of the informed traders, they might decide to stay actually in the lead market. And there is some anecdotal evidence from the COVID-induced volatility in March 2020 that shows that since traders decided that they need liquidity, they prefer to trade in the market. So temporarily there was a migration from the dark pools to the lead market when we had this exogenous shock in volatility. Now, let us see how market performance affects how dark trading affects market performance in each of these situations. So in the first situation, this equilibrium in which the informed trader submits market order and the uninformed submits limit order, when there is migration to the dark in the first period, I'm going to see that there is a decrease in the price informativeness. And this result on the price informativeness is not surprising because traders who had information, now they decide to trade in the opaque venue, in the dark pool. So they don't contribute to the price discovery process. Now, what is the effect on liquidity? We see that in this situation, when the traders were demanding liquidity in the lead market, their migration to the dark leads to a situation where inside spread decreases, or alternatively the liquidity increases. And this has positive effects on the expected total profits, or the informed traders' profits and uninformed traders, while there is no change for liquidity traders. Now, what happens subsequently depends crucially on what happened initially. So in this situation, since I have the informed trader consider optimally to migrate to dark, it will be again optimum for the new trader to go to the dark. And we will obtain that again, this informed trader that was willing to, was demanding liquidity in the lead market, he will decrease the spread because now he goes to the dark. So in this situation, the effects on the insider spread and the total profits are quite positive. Similar results we obtain for stocks that we call them high stocks, because there are this equilibrium happens when the volatility is high and also when the probability of informed trader is higher. In the first period, initially, we have exactly the same results we had in the case of the high-low stocks, and the mechanism is exactly the same. The only difference is that in the case when the probability of informed trader is very high in the market, in the lead market, we might get to a situation when the uninformed traders that initially in the single venue market will decide not to trade because of this high adverse selection problem. So there are a lot of informed traders in the market, so they would find optimally not to trade. Now, when there is a dark pool, they will decide to trade in the dark pool. However, when the probability of when the execution risk in the dark is going to be low, they will end up by having lower expected total profit. So although their decision is optimal in that moment, due to the changes in prices that we had initially, this will affect their trading profits, and they are going to be worse off with when the dark pool coexists with the limit order book. But in general, in the case of high volatility, the effects on inside spread and profits is beneficial for market performance, although almost always the effect on price informativeness is negative. Now, what happens in the case of the low volatility stocks? In the case of the low volatility stocks, we had these traders that they were supplying liquidity in the lit market, and now they decide to migrate to the dark pool. This, of course, has a negative effect on the spread, because instead of supplying liquidity in the lit, they go to the dark pool. So they spread increases, so the liquidity decreases. Now, initially, this doesn't have, it has a positive effect. Migrating to the dark pool has a positive effect on the dark, on the profits of traders, but subsequently, the impact can be quite important. So this increase in the spread might affects the decisions of uninformed traders, and depending on what is the situation, for example, as I mentioned before, if the probability of informed trading is high and the execution in the dark is relatively low, we might end up with this situation where uninformed traders are worse off with the dark, when the dark pool exists. Now, also, what is important to see that in both cases that I presented here, when there is migration to the dark pool, since there is this increase in the spread, this impact negatively on the liquidity traders. So in the case of low volatility stocks, the results are relatively mixed, and they depend crucially on what is the market condition. So they depend, in addition to the volatility, it will depend on the stock liquidity, on the trader immediacy, and of course, on the information that the traders have. So how these results, the theoretical results, can be reconciled with the empirical literature? Well, one of the motivation of our papers came from the fact that the empirical literature is quite mixed. So, for example, when we look at the price discovery, we have several papers that show that it harms price discovery, some of them that has no impact on price discovery or increases price discovery. Our results, most of the time, are consistent with these results that price informativeness decreases. However, there are some particular cases when there is no migration initially. The informed traders consider it is not optimal to migrate to the dark pool, and we end up with a segmentation of the order flow in which the informed traders, they decide to stay in to trade in the lit market, in the limit order book, while the uninformed traders, because the probability of informed trading is high, and they do not like this high adverse selection, they might decide to go to the dark pool. So by decreasing, by not trading in the limit order book, the price informativeness might increase. However, this situation is a very particular situation when I have this clear segmentation, but the segmentation is that the ones that stay in the market are the informed traders, while the ones that decide to go to the dark pool are the uninformed traders. So these both negative and positive effects on price discovery come exactly from this segmentation of the informed and uninformed order flow. And as I explained, this segmentation is depends crucially on different stock market characteristics. Now, how this affects liquidity? The results on liquidity are not as good as somehow. So in the case of price discovery, most of the results agree that adding a dark pool harms price discovery, while here the results are quite mixed. So we have a situation where there are papers that show that the market liquidity decreases, while there are some papers that show that the market liquidity increases or it's not affected. How our results are consistent with this? Well, we show that adding a dark pool has decreases liquidity when I have this high volatility stock, and increases liquidity when I have these low volatile stocks. And our results are somehow our model captures also this theoretical result of Butirindi and Werner. In the case we have this low volatility, low pin stocks, what happens is this is in the limit. We go to the situation when the informed or the traders do not have any informed information. So somehow is consistent with Butirindi and the Werner paper. These results can be reconciled by showing that the effect depends crucially on these stock market characteristics like volatility and liquidity, and they also depend on traders' characteristics such as information or immediacy. Now, how can we use this in order to try to explain how the double volume cap mechanism affects the performance, the market performance of the lead market? As I explained before, it is crucial to understand whether the cap is binding or not. Now, in the situation when the cap is binding is not a problem, but when the cap is binding, this policy limits the benefits in the case of the high volatility stocks, but also the drawbacks that introducing the dark pool alongside the exchange has in the case of the low volatility stocks. So the focus should be on this kind of low volatility stocks where the effects of the double volume cap might actually be quite mixed and therefore important. Our model can also somehow have some implication on how limiting the HFT trading in dark pools affects the other market participants. If we think of the informed trader as an HFT trader, it's a trader that doesn't necessarily have information but processes faster than the other trader. Limiting the access of this trader in the dark pool does not increase the profits of the uninformed trader, and it might decrease both the profits of informed, uninformed, and liquidity traders for these high volatility stocks when the PIN, the probability of informed trader, is not extremely high. So what our paper suggests is that these restrictions have to take into account the stock characteristics and market conditions in general. So the question that we try to answer is whether the dark trading harms market performance or not. If we look at price informativeness, most of the time we can say yes, it decreases, except the situation when the probability of informed trading is not very, very high. While when this probability of informed trading is high, it might depend. It decreases initially, but increases subsequently for these high volatility stocks. If we look at the liquidity, we can say that no for the high volatility stocks. So liquidity increases for the high liquidity stocks, while it depends for the low volatility stocks on the other market condition. It decreases. We know for sure that it decreases initially for the low stocks, as these traders, the informed traders, do not supply any more liquidity in the market, but it might increase or decrease subsequently. And finally, if we look at the trading profits of liquidity traders, we can say that it does not harm liquidity for the high liquidity, high volatility or high liquidity stocks, while it decreases the profits of liquidity traders for these low volatility stocks. So we think that our paper contributes to understanding what are the implications of the dark trading and has important implications for regulation, given the increasingly intense constraints that regulators across the world are trying to impose and that were already imposed in Europe. And our results show that the regulators should pay attention to these low volatility stocks, where unintended consequences of their regulatory constraints might have important effects. So we think that the regulatory constraints should have a flexible, should be flexible and should take into account the stock market characteristics. Thank you.
Thank you very much, Arianna, for this impressive presentation. I will now leave the floor to Andrea. Since I've already presented previously, needs no presentation any longer. I'm sure, Andrea, I'm sure your discussion, you have been given enough high quality food for a great discussion. So please, the floor is yours. I don't know what's... It looks like we are having a bit of a problem with Andrea getting in. Okay, here you are. Thank you.
Hi, thank you for the invitation. I cannot share the screen. Let's see now. Here.
Yes. Yes, you can.
Perfect. I'm going to present the discussion on the paper that Arianna has presented, Information and Optimal Trading Strategies with Dark Pools. The structure of the presentation is as follows. First of all, I'm going to present the motivation of the paper, the objectives, some main takeaways, and finally, I'm going through the main comments of this presentation. In regards to the motivation, they already explained the main characteristics that dark pools have, which is they lack transparency, pre-transparency. That means that we don't know anything. We just send an order to the trading venue and we wait that that order is going to be executed. Maybe at the midpoint or maybe at the best bid or the best ask, depending on the trading venue. The impact that dark pools have on market quality and price discovery has been studied empirically and theoretically. And it seems like that this issue is of a big concern, not just for academicians, but also for regulators. Regulators are actually very worried about some potential unintended consequences that pools may have on price discovery, liquidity, etc. In that sense, they actually implemented the caps and limits on the amount of dark trading in a stock, for instance, 4%, and on any dark pool, on any dark pool, and 8% across all dark venues. It seems that these issues is very important from a practitioner point of view, from regulators, and this paper, the paper Arianna has already presented, has the aim to try to understand how price discovery, liquidity may be affected by dark pools. Sorry. For instance, if we look at this graph on the evolution of the market share of dark pools in trading in European stocks, what we can see is an increase since 2009 until 2015, maybe a bit later as well, but I don't have the time series not longer. And this deserves taking into account all the fact that the market share has also increased a lot. It is important to understand if trading a lot on dark pools may have a potential negative impact on market quality and the price discovery. Consequently, the main objective of the paper of Ariadna with her co-author is to understand competition between a limit order book, for instance, Nasdaq, Swiss exchange, with a dark pool which crosses orders at the midpoint. An example of this type of dark pools is Swiss at mid. What are the main takeaways? Of course, I'm not going to talk about all the potential possibilities. I'm just going to talk maybe for one specific case, and that is like the impact of a dark pool competing with an exchange when there is a high probability of execution is going to of execution in dark venues. And what they have found is very interesting. On the one hand, we see a decrease in price informativeness. However, in the case of liquidity or inside spread, the consequences are not so clear. For instance, for high stock fundamental volatility, liquidity may increase in T1. However, for low stock fundamental volatility, liquidity seems to decrease. Consequently, depending on the characteristics of the stock, we may have an increase in the inside spread, or we may have a decrease in the inside spread. Before moving to the comments I have for their paper, I would like just to point out the novelty of this paper. First of all, I would like to point out that this is the first paper on trying to understand how competition between an exchange, a limit order book, in interaction with a dark pool in the presence of long-lived asymmetric information is going to have on different dimensions of market quality. Another novelty in the paper is the fact that they allow uninformed traders to learn from the limit order book. If in T1 something happened in the limit order book and an uninformed trader arrives in T2, they can observe if there has been a change in the bid or in the ask, and they can infer from this type of information if there is an informed trader in the market or other type of information that could be useful for them to make decisions. And finally, another feature of the model is the fact that they allow dark orders to be first routed to the dark pool and then to reroute it to the exchange. What are the main, now I'm going to present just very briefly what are the main ingredients of the model, and then I'm going to comment on some assumptions of the model. Basically, Ariana already explained the type of traders. We have a liquidity trader that is going to trade on liquidity shocks. They will send all the time a market order to the limit order book. And then we have also rational traders, which can be uninformed or informed. The informed trader is going to know the liquidation value of the company. However, the uninformed traders just don't know the distribution of the asset conditional and public information. Both of them, rational traders, both types of the rational traders can send both market order and limit orders to the limit order book, and they can send orders to the dark pool. This is like the game, the stages of the game. And finally, I'm going to present my comments on this paper. First of all, one of the assumptions of the model is that the probability of execution is going to be exogenous, and it's going to depend on the imbalance in the dark pool. conditioning the execution of the probability of execution on order imbalance may be slightly unrealistic, because at the end of the day, if we have a dark pool, it's unlikely that we would know what is the order imbalance. Taking into account this, what I am thinking on is the fact that actually the probability that an informed trader or uninformed trader will go to a dark pool may have consequences on this probability of execution. And actually, there are some conflicting theories on where informed trader will trade. For instance, Zhu says that the probability of execution of an informed trader is lower in the dark pool. Why is it lower? Because they are going to concentrate on one side of the market. They are going to send cross-order correlated orders to the dark pools. They are going to be, let's say, on the buy side, and it's very unlikely that they will get executed. Consequently, if the probability of execution is very low because they are going to trade on the same side of the market, they maybe will stay in this change, trading this change, and this will have an impact on price discovery. On the other hand, there are other theories that say no, actually informed traders may prefer to trade in the dark pools due to the anonymity in dark pools. This is they are conflicting in the sense that on the one hand, we have reasons to think that the probability of execution is going to be lower for an informed trader in the dark pool. But at the same time, there is another stream in the literature that shows that actually the anonymity in a dark pool is going to attract more informed traders. Given these conflicting theories, I am wondering, I am wondering if ex ante the type of traders may determine the probability of execution in dark venues. So, like one suggestion I am thinking on, instead of modeling the probability of execution in dark venues on the order imbalance, which in theory we should not see because it's a dark pool, maybe we could model it based on the probability of an informed trader to arrive in the market. And I'm wondering, if that's the case, what new predictions the model would yield? Actually, I think that if we would model the probability of execution in dark venues, exogenous, based on the probability of an informed trader to arrive to the market, maybe it can give us some intuitions on potential tests that we can do empirically. This is one, the first comment I have on the assumption probability of execution is exogenous. The second comment I have, it's on the assumptions privately informed traders. I am wondering, what about if we assume that there is an increase in the probability of trading against an informed trader relative to trading against a liquid trader? What new predictions the model would yield? Like, let's suppose that there happens something in the market, there is a shock in the market, there are earnings announcements or macroeconomic news, and as it has been in the literature, there is going to be an increase in the number of informed traders related to liquid traders, and how this can affect or change the predictions of the model. So actually, even like the potential predictions of the model may help empiricists like me to test maybe those results. For instance, we can have an exogenous shock like macroeconomic news, earnings announcement, or all type of news, and see how this may change. Because we may see, like, we may identify maybe informed traders, we may see like trading volume in dark pools, and we may draw some conclusions empirically. And finally, the final comment I would have on the paper is assumption liquidity supply is exogenous. Of course, I think that it's very, I mean, the liquidity supply, we know that is not going to be exogenous, but I'm aware of the fact that it's very, very difficult to model that, everything to be endogenous. However, maybe we could say, what about if noise is positively linked to news? What new predictions the model would yield? Again, the prediction could be tested empirically and may help us to understand better this issue on what is the real impact dark pool has on market quality, price discovery, etc. These are my main comments. I would like to thank Ariana for her presentation and for the paper. I think that the paper is very nice, intuitive, and it has very nice conclusions.
Okay. Thank you very much, Andrea. That was also a very nice discussion of Ariana's paper. I only have one question from the audience at this point, but I think before I present it to you, Ariana might want to, reply or comment on your presentation.
Okay, thank you very much, Andrea, for a very nice discussion. So yes, one of the problematic modeling technique that we are going to use here is that we assume that initially both the limit order book and the dark pools, they have some liquidity that is provided before the first in the first period some traders arrive to the market. Yeah, so in order to be able to understand what is the effect of information, I have to assume that both in the case of limit order book and in the case of dark pool, there is some exogenous liquidity there. However, the reason we model this dynamically, it's also because we understand, as Zui very well explains, is that this affects the trading decisions of players, of market participants, affect the decision to go or not to the dark pool. So that's why in the second period, we have this endogenous execution in the dark pool, trying to acknowledge that, of course, the traders decide to go to the lit market or to the dark pool, and this decision is based on the information that they have in the market. So I totally agree with you that this is an important question. But in order to be able to solve this type of model that is quite complex, we have to limit to this assumption. Now, one important difference between our paper and the zoo papers is that we have one trader arriving at the same in that period. So we do not have a pool of traders. Some of them might decide to stay in the lead market, and some of them go to the dark pool. So what we look at is the decision of the traders in the moment he arrives. And this is quite important because I cannot model as zoo, and well, we didn't want to model as in zoo because in the in the dealer market, the problem that we have is that there the traders can only demand liquidity. They can submit only market orders, while here we wanted to understand what is the problem of demanding or supplying liquidity, because we think that information asymmetry is very important, it's crucial in this decision. So that's it's simply a modeling technique that it has indeed this shortcoming that initially both in the limit order book and in the dark pool, the liquidity is assumed to be exogenous. Now, and I think it would be very difficult to model to have noise traders that is correlated with the news, especially because of this exogenous probability of trader arrival. And regarding to your second point, so actually we do have this analysis. So as I specified, what we assume is that we have a trader that arrives, and then with some exogenous probability, this trader can be informed or uninformed or liquidity trader. So what happens is that exactly in this situation when the probability of informed trader increases, we might end up with a situation similar to zoo, when informed traders, they might decide to stay in the market, but the uninformed will go to the dark pool, and therefore we have this increase in the price informativeness. So somehow our model, when the probability of informed trading is very, very high, it gets very close to the, and we obtain similar results to the case of zoo, where traders decide to demand liquidity in the market, supplying market orders. So it's similar to a dealer market. And when the probability of informed trader becomes very, very small, so practically there is no information in the market, we get closer to the results to Buti, Rindi, and Werner. And this is quite interesting that we obtain these results only in the first period. Yeah, so when the probability of informed trading becomes very, very small, our results are closer to this market where there is no asymmetric information, but only in the first period. Why? Because in our second period, the uninformed traders include this information in prices, and therefore their decisions are completely changed. So regarding the consequences of this exogenous probability informed trading, we do have it in the model, and is related to this probability of informed trading, to the pin that I mentioned before. And it's a crucial variable, because this measures the adverse selection that we have in the lead market, that is crucial for the decision of demanding or supplying liquidity, or going to an alternative trading venue.
Thank you.
Thank you.
Thank you.
Okay, then I will just go and give you the question, which is actually a very practical question, Arianna. Our correspondent here is asking you, how should we think about T1 and T2 from your model when applying it to the real world? So what is T1 and T2?
So we can think of the T1, a moment when there is an information shock in the market, when we have some earnings announcements, and the T2, the period immediately after that. We can think, for example, as an opening auction. At the moment we have at the beginning of the day, and then the T2 as the period after the market. So practically is a moment where I have some information entering in the market, and when the T equal to 2 is the moment, is the period of trading where this information is included in prices, and traders might use public information that previously was not available when designing their private, their optimal trading strategies.
Okay, thank you very much. That's a clear response. Unless either of you wants to do any concluding remark or any observation, which from your faces, I guess not. I think we can conclude this session. I have to say, the whole session with you and the two previous speaker and discussants has been extremely informative. I thank the four of you for your very wise, complete, exhaustive presentation. I think it's been very informative, and we really appreciate and thank you for your willingness to share your knowledge, your research, and observations with us. I think the whole audience, it's a pity that we are not there, because I think you should deserve an enormous round of applause. Thank you very much.
Thank you for a fantastic opportunity to present our paper.
No, the opportunity has been on us, definitely. And we hope you will have some time to participate in the forthcoming keynote presentation, and also tomorrow, which is, of course, it might not be your side of research, but it's still also extremely important and very interesting, because it would have to do much more with investors, protection, etc., which is, at least from our point of view as regulators, is one of the main concerns. So thank you very much again.
Thank you.
Now, now we will go to the last part of today's meeting, in which we will have the keynote speech by Richard Evans. Here he is, I guess. Okay, Richard, a nice photo here. Okay, now, in reality, you look much better. It is very hard to present Richard Evans because, you know, his bio is, you know, his CV is enormous. And I have to say one thing that, I don't know whether this is politically correct or not to say, but one thing that impresses me is that those people who can do so many different and important things and do them all well. Like, how can someone have a bachelor and master degree in chemistry from one university and then have a master's degree and doctorate in finance from one of the most prestigious schools in the world, which is the Wharton School of the University of Pennsylvania? I mean, I really would like you to, you know, besides giving you your wise recommendations and your wise you know, precisions on what on the matter of this conference, at some point I think I would like to have your personal advice as to how you get to do all these things so good. Okay, Richard is at present holds the Donald McLean Wilkinson Research Chair at the University of Virginia Darden School of Business, and his research deals with investment decisions. His current research projects explore fund manager compensation and incentives, exchange-traded funds, corporate political activity and stock performance, short selling, quantitative versus fundamental investment strategies. Okay, the whole works. Okay, his work has been published at, you know, you name all, you know, you just name all the important reviews in the matter, and you will find his name there. And he, at the same time, he has also and is also advisor and working closely with regulators like the US SEC. So with this, you know, with all that stuff, I don't think there is any much more that I can say before I introduce him. So, Richard, please, the floor is yours. By the way, you have 1 hour and 15 minutes for your speech. We do not expect that you will exhaust yourself for all these minutes. Just we are giving the audience time to ask questions in case they have them, which I'm sure they will. Thank you.
Udall, thank you so much for that very kind introduction. The truth of the matter is, the reason I've done so many things is I'm so indecisive. So I chemistry, and I dabbled there for a while in my younger days, and now in finance, where I feel a lot more comfortable. But very glad to be here, especially grateful to Udall and Juan Pedro, the organizers at the CNMV and IE University and Business School, for putting together this conference. I am a strong believer that academics, regulators, and practitioners, when we interact with each other and listen to each other, we wind up making better decisions at the end of the day. Now, that doesn't mean necessarily we'll all convince each other of our perspectives, but it does mean that each one of us, if we incorporate the ideas, the insights of the others, might be better able to implement, you know, whether it's an academic agenda, a regulatory agenda, or practitioners trying to enhance their practical activities. So this is a superb undertaking. I am honored to be here. I'm going to present a couple different papers and some broad insights. So one that's published and another one with Juan Pedro Gomez. And so I'll give you a broad perspective a broad perspective on MIFID, in particular as it relates to bundling. So let me see if I can get my PowerPoint to move forward here. So now it goes without saying, you've heard some papers this morning. If you join us tomorrow, you'll have some additional papers, that MIFID II is very broad in scope. So it's investment advice and information disclosure to clients, systematic reporting, suitability, governance, marketing communications. It touches many different aspects. In fact, one of the widest reaching regulatory agendas I think I've ever seen in my life. Now, my focus today is on a subset of that, specifically the bundling of trading cost and research expenses. Now, why that? Well, one, and first and probably most importantly, I have some expertise in that dimension, have published paper and working on papers related to that. But second, I think it's one of the more controversial dimensions of this regulatory agenda. Something that's not just of interest to EU, but I think regulators around the world are looking to this bold step that the EU took to see how it turns out, how they might modify, or what changes they might make to their regulations as well. So this is not to say these other dimensions of transparency and suitability and governance are not important, but this is the one I'm going to talk about today for what it's worth. Now, I want to start with a simple question to all of you. Right? So we're thinking about bundling, and there's a long economic literature and a long marketing literature and even a long management and leadership literature about bundling and the choice to bundle goods. So I want you to imagine for just a second, what goods and services do you bundle? Now, chances are you're not a supplier per se of those services. I think more in terms of a consumer. Are there goods and services you purchase as a bundle? And ask yourself, why is it you purchase those things as a bundle? So for example, you might want to bundle your TV, your internet, and your phone. And so that would be a common bundle that I think whether you're in the EU or the US or other places might be offered to you. Now, some places allow you to bundle different insurance policies. This is common in the US. This ad I have here from Aviva is actually from Canada, but bundling home and auto gives you a discount relative to having either one of them a la carte. Or maybe one that not many of us have used in the past year and 3 months, but bundling, travel. So whether it's your airfare and your hotel, they come from different providers, but putting them together sometime can get you a discount or better access or, whatever reason you might want to bundle. Now, I recognize that it's a little unkind to bring up travel when all of us have probably wanted to travel over the past year and 3 or 4 months. At the same time, I'll have to be honest, when I agreed to this talk originally, I imagined after finishing that Juan Pedro and Udald would take me out to a very nice dinner in Madrid. And instead, I will be going to a very mediocre lunch by myself in Charlottesville, Virginia. Right? So I understand the pain associated with not being able to travel. But the point is, this is a common bundle. Now, ask yourself, why do you buy these things as a bundle at the end of the day? Well, the economic literature has a number of explanations for bundling, why it exists, and some really fascinating models. Now, this article I'm referencing at the bottom there by Bhattacharya in 2020 has a nice perspective, I think, broadly. It's not fully comprehensive, but I think it gets most of the main points. And it's really an economist writing for a legal or regulatory audience. So it's something I would highly recommend taking a look at as you want to think about this issue more broadly. But we can think about 2 types of product bundles. The first one is a pure bundle, right? What is a pure bundle? There's a price of good A and a price of good B. And individually, both of those prices, the price of A is actually higher than the combined price of A and B. The price of B is higher than the combined price of A and B. Now, that's less the context in which we find ourselves, I think, for the MIFID II question. It's more of this mixed bundle. And what is a mixed bundle? Well, price A by itself is less than the combined price of A and B. Price B by itself is less than the combined price of price A and B. But price A plus price B is greater than the bundled price. So I'm getting a discount of some sort. And it's this mixed bundle that largely is where our interest as economists might lie in thinking about bundling. Okay, now, why does bundling exist? Well, the literature offers a host of possible explanations. Demand complementarities. So think of 2 different products. For example, the Apple Watch and Apple Fitness Plus. Now, I might like Apple Fitness Plus, but the fact that the 2 come together makes me want an Apple Watch even more, right? Because I need this Apple Watch in order, or an iPhone as it were, to access this other product, the software or app at the end of the day. So that would be demand complementarities. Economies of scope, right? So why is it that phone and TV and internet services are so often bundled? If they come via the same medium, a cable into your home or whatever that mechanism might be, then there may actually be discount in producing and selling all of them simultaneously for the supplier. Or price discrimination, right? Basic versus premium cable. Right, so basic is just a few channels. Premium bundles a number of individual channels. So Juan Pedro Gomez, who many of you will know from IE, he might really prefer the European football channel. Now, I, as an American, might really prefer the American football channel. And yet, in premium cable, even though each of us just wants one channel, they're combined together, and that price discrimination allows them to separate and sell the basic bundle to some individuals and that premium bundle to both Juan Pedro and myself. Now, these I think of as largely being either neutral, sometimes positive, and I guess in some circumstances, possibly negative for consumers. However, there are two more nefarious reasons, if you will, as to why bundling might exist. One is leverage, right? So when I think about leverage, I always think about my iPhone and Apple Maps. Now, Apple Maps comes bundled with my iPhone. I've tried to delete it. It turns out I can't. And yet I have never used Apple Maps once in my life. So Google Maps is what I use. It's always what I use. And so leverage says, listen, if you want one thing really bad, I'm going to force you to have this other product, good, or service combined with it. Okay, fair enough. Now, the last one is the one that my previous research, as it relates to bundling, not of research, but specifically of distribution, so the cost of selling or distributing financial products with brokerage commissions, is opacity. Right. And so what would this mean? Well, if I don't quite know the price of two goods and I combine them together, I might make it even harder for the consumer to discriminate how much are they paying? Are they willing to pay that much? And so that would be an opacity, an explanation of opacity. Now, when I think about this literature, there's one other very important caveat. So this literature often thinks of a supplier and a consumer, right? A firm that's producing product A and B, and then a consumer who's buying product A and B. Our situation's a little different, I think, in important ways, as economists and even regulators think about, the underlying implications. We have a supplier, which would be sell-side research firms that also bundle, their opportunity or the ability to actually trade for you, trade on your behalf and implement those trades. An intermediary, which would be the investment advisor who's choosing, to buy and sell stocks on behalf of the consumer, and the consumer who would be the end investor themselves. Now, that makes it a little trickier. And so some of these models and their predictions aren't quite the same if you think about this intermediated context. At the same time, I think about soft dollars. So in the United States, there is still allowed and has been for a long time, this practice of soft dollars. Soft dollars is just when you bundle other goods and services with the cost of trading, those brokerage commissions at the end of the day. So in July of 2008, SEC Chairman Christopher Cox said, one of the most significant conflicts of interest arises when a fund's investment advisor uses soft dollars as part of its business practices. Now, why is that a conflict of interest? Well, he says, listen, soft dollars are essentially credits earned from brokerage commissions that a broker-dealer's customer can use to pay the broker-dealer for research reports or other things of value. They represent the assets of investors, although, and this is the important caveat, investors themselves neither monitor nor approve the accumulation and spending of these assets. Okay, now, does that mean that they're nefarious in and of itself? No, but it does mean this issue about opacity and possibly leverage, those possible explanations for bundling, should be weighed carefully against those alternatives, demand complementarity, economies of scale, et cetera, et cetera. Okay, now, so the first work I did on this was purely from a US perspective, right? And so we looked at these soft dollars in this Journal of Financial Economics piece in 2012 with my co-authors Roger Edelin and Greg Cadlick. And we focused on a form of bundling that's different than what I'm going to discuss today and what MIFID addresses, which is research combined with trading or brokerage commissions. So our example, to give you a sense of what we did in this, well, we think about, two firms, two investment advisors in our sample. So MFS, who is largely an active investment advisor in the US, at least over the time period we were looking at, versus Vanguard. So we took the actual brokerage commissions from these different firms and we separated them into two parts: a base, which was how much you were paying for standard execution, and then an extra component, which was the additional component you were paying for bundled services. So that base, right? So the execution only component of it for MFS and Vanguard looks like this. So they're both as a percentile rank relatively low, which we would expect from large investment advisors. Vanguard was much larger than MFS, and so you could imagine they have an even lower rank here because they're getting bigger volume discounts or something along those lines. But it turns out it's not just the base execution we care about. In the regulatory framework in the US, you could bundle but had to describe the other considerations that you took into account when you selected a certain broker or dealer to execute your trade, right? So I send commissions to somebody, what are they, and here we have simple yes, no question. But for example, the question of interest for MIFID II, and largely the one we'll talk about towards the end of my talk today, is whether or not receiving investment research was bundled with your commissions. Now, for this JFE paper, we focused on a different one, specifically distribution, which is no longer allowed in the US, but provided a really nice setting, as I'll talk about, to look at soft dollars versus hard dollars. So specifically, what would distribution be? I use a given broker, I send them these brokerage commissions, part of which goes to pay the sales force of that broker to sell my investment products, my fund, shares of my fund, etc. Okay, so if we look at the distribution/sales component, you can see now it's quite different. MFS seemed to use this, according to our data, to a much higher degree than Vanguard. In fact, Vanguard, even though it's not at the 0%, that's only statistical noise. Statistically, they're not different from a 0 percentile here, largely because they're directly distributed, right? They don't use a sales force or compensate a sales force for selling their products. Okay, now, is this a big deal? Should we worry about bundling from this perspective of opacity? Well, as an anecdotal example of what the paper finds, consider MFS. So in March of 2004, there was an SEC enforcement action against MFS. Why? Because they had directed their brokerage in exchange for fund distribution. They were bundling the cost of distribution with their brokerage commissions. Okay, lasted from January 2000, November 2003, and ultimately that enforcement action was because MFS did not correctly disclose these relationships. Now, my understanding, having spoken to people who worked on this particular case, was that bundled commissions played a key role, and this was a relatively straightforward enforcement action because MFS had internal documents describing how exactly this should work. So for example, consider this excerpt. It's incumbent upon the employee to negotiate the best deal for MFS. Usually this means trying to cover as many costs through soft dollars as possible. Now, to be clear, it was not illegal to do this at that point in time. The issue was about whether or not these were disclosed and how they were implemented at the end of the day. You could bundle at this point in time distribution with brokerage commissions. But the real question is, okay, if I paid for it with hard dollars, so think explicitly expensed expense ratio versus soft dollars, was there a difference in the cost? And so for this particular case, the bundled commissions, paying for distribution via that bundling, was much more expensive. It was 1.5 times more expensive than if I had paid through hard dollars. And we know that because we can see distribution costs that come out of the expense ratio relative to these bundled distribution costs at the end of the day. Okay, now that's just one firm. MFS has cleaned up their action. I mean, it's way in the past. We're talking 20 years ago, but I wanted to give you some sense of how this opacity might be a concern when you're bundling these goods and services together. Now, the paper doesn't look just at MFS, we look at all firms. And like I said, we take these total commissions and we decompose it into a predicted and a residual part. The predicted is based off the type of factors you might expect. How big an investment advisor are you? How often do you trade? What styles are you trading? Et cetera, et cetera. Now, the residual component is picking up, at least it's our proxy for, at least one of the proxies we use in the paper, for these excess or bundled commissions. Okay, so two big questions the paper asks and answers is, okay, these residual commissions used for distribution, one, were they effective? Did they actually engender increased flows at the end of the day? And what is their impact on performance? Now, on the left, we've got the regression looking at flows, and you can see here whether we use just residuals, that positive coefficient there with a t-stat of 4.3, or whether we take residuals and interact with that yes-no dummy from the NSAR disclosure that says whether or not they did actually pick their brokers as a function of their willingness to sell and distribute their funds, we find a very strong positive coefficient on flows. So what does that mean? Those payments were effective. They brought funds, inflows into the fund at the end of the day. then the question is, what impact did they have on performance? Well, we find a strong, very negative relationship between these distribution bundled costs and performance. And the difference is statistically and economically significant when we compare these soft dollars to hard dollars, right? And so that was one of the most important components of this empirical framework, is that we could look at bundled versus unbundled at the same time and compare their impact on performance. And what did we find? Well, they were much more negative to performance if they were bundled. And the flow evidence would suggest they were less transparent, more opaque for investors. They didn't know exactly what they were paying in those bundled commissions at the end of the day. Okay, now we also had a nice setting in our data in that the SEC banned this practice in December of 2004. So we could use, and you can see it's a little bit slow to appear in the data for a number of reasons that we describe in the paper, but you can see 40% of the funds in our sample distributed, they bundled their commissions with sales or distribution the first half, and then as soon as it was banned, it drops down and gets to zero. Why does it take a little while to get to zero? Well, it turns out the SEC formal rule allowed funds to make changes to their regulatory filings at the time of the next regularly scheduled amendment. Okay, this is important because we can see the same fund before and after that change and the impact of these bundled commissions on their performance. And what do we see? An even stronger negative relationship between these commissions, these bundled commissions and performance, using this much more precise window. Same firm before and after, bundling, not bundling. What's the impact on performance? And this is what we see. So overall, that paper says commissions are are commissions transparent? No, net fund flows seem to decrease with higher expenses and loads, the more, specifically the distribution portion of that. So the more transparent payment for distribution. And yet we find very strong positive flows and distribution consistent with greater opacity, but also greater efficacy of those distribution payments. Now, how do they affect performance? We find a strong, statistically, economically significant relationship between these soft dollar payments for distribution and performance, and even more so than hard dollar payments for distribution and performance at the end of the day. Now, it's important to say, well, listen, okay, that was a concern. The SEC did the right thing, in my humble opinion, in banning payments for distribution, but distribution versus research are very different things to bundle. Right, so when I think, going back to that framework of why you might bundle, consider distribution versus research bundled as a part of brokerage commissions. So example, demand complementarities or economies of scope. In my mind, those are both much more compelling reasons to bundle research than they are distribution at the end of the day. So in my mind, I would say, listen, there's a better case, I think, based on those two factors, to bundle research in a way that might be beneficial for consumers, or at least not negative for consumers. Now, price discrimination and leverage, I'm not sure. In my mind, it's hard to imagine a scenario where those really play a role in bundling for distribution or research. So I don't know how to assess those things, but opacity is one, a more worrisome one that actually in my mind is also perhaps a greater concern for research. Well, why? Well, distribution costs before, think about our setting, there were hard dollars and soft dollars, right? So there are ways for investors to see, or you could select funds, for example, that only charged a hard dollar expense for distribution. Research, on the other hand, there really isn't a way to see what those, the bundled component of those are at the end of the day. And so in my mind, even though there's potentially a greater case, economically good case, as it were, for bundling research, there's also greater potential for an economically bad case for bundling research. So this means, there may be great reasons to bundle research. Maybe MIFID II or MIFID III should reverse this and allow bundling. But there's also the potential for this to be even more opaque and, an even worse factor at the end of the day for investors, right? So the question's open. It's an empirical question, and one that I think as academics we've been challenged to try and consider. And so I'm going to give you one approach to try and address these issues. Now, when I think about MIFID II, right? So now the regulators implement it and practitioners respond to that implementation, and their interests are very different, right? As an academic, I often look at these and say, is this econometrically, is this statistically a nice setting in which for me to address this question, right? So consider, and you could find other data on this, but the CFA Institute survey, so about a year after MIFID II, they reached out to 496, to a host of the CFA charter holders in the EU. They got 496 responses from 449 firms. 50% plus of these are either managers, fund managers, analysts, or investment advisors, C-suite members, right? So it seems like this is a reasonable sense. So you want to compare, on the left are the percentage paid for investment research in 2018, post MIFID II, and 2017 before. Now, when I look at this, what I see basically is the green bars go up and everything else goes down. And what does that mean? It means there's a large shift towards firms paying for research directly out of their profits and losses, right? Okay, well, the problem is that's not an ideal empirical setting. I mean, what I'd really like is the exact same fund, like split in two, cloned, one of which bundles, one of which does not bundle. If I really want to say something about, is bundling good or bad for performance? Is it good or bad for market efficiency, et cetera? And this design, right, the choices of companies, basically almost everybody to shift towards this means there's not a lot of cross-sectional variation. It's hard for me to look at this and think, well, how am I going to assess this one way or the other? Okay, fair enough. Now, you could say, well, what if there were changes in how much is spent on research, right? Sometimes it goes up, sometimes it goes down. If I had cross-sectional variation in that as well, I'd also have a great opportunity to say, okay, these firms spend more. How does that affect performance? They spend less. How does that affect performance? And is that, performance increase and decrease proportional to how much they're spending on research? The problem is, almost every firm, as you can see here, at least the sizable ones, are decreasing how much they spend on research. So it turns out Switzerland has a slight increase, and these firms less than $1 billion have a slight increase. But once again, because everybody moves one direction, it's hard for me as an academic, as an economist, to use this in an empirical setting to try and tease out whether or not bundling is good or bad for investors or for market efficiency. Okay, now, what is the issue? Well, there's another issue here too, which is these important market movements. And to give you a sense of that, I think one of the more interesting, and this is something that the academic literature has spoken a great deal about recently, and kudos to my colleagues today, tomorrow, even a more recently published paper in the JFE that looks at this issue about market quality, right? So if you change bundling, you might have a dramatic impact on analysts. And as this article suggests, and this report from Substantive Research shows, there's a dramatic decrease in analysts, since the MIFID II unbundling. Okay, now that seems striking and important. That might have really negative implications for market efficiency. The problem is there are other trends going on at the same time. So later on in that same article, it says, EU Markets Watchdog said it found no material evidence that unbundling had harmful effects, as critics have suggested. And the problem is there's a general trend in that direction. Okay, so what do you have in this figure? It's a long-term increase in the companies losing coverage. So think of this as the number of companies that have lost coverage entirely. So we've got large firms and these small and medium enterprises. And you can see the red line representing implementation of MIFID II, there's a trend upwards, right? So the fact that it's continued to go up may or may not be due to MIFID II. When the trend's headed the same direction as you might think the implication of the regulatory shock, then it's really hard to tease out that effect. Now, you can look at that. You can look at what the number of analysts covering each company before and after MIFID, that sort of trend. You can look at shocks to earnings, disagreement over time. The problem is you've got these market forces at the same time as MIFID II that are perhaps moving in the same direction, which confound any attempt, as it were, to try and assess, is this really good or bad for investors? Is this really good or bad for market efficiency at the end of the day? Okay, well, so this is tricky, right? Other than being thoroughly depressing, like we can't answer this question, is there some way to address this? Well, let me take you, sorry, this is the other, when I think about the market forces that are at work here, one of the most important is this dramatic shift to passive that we see happening all around the world, right? So if you look at, for example, this is Morningstar direct data, but the organic growth rate of index and non-indexed funds over time from 2010 to 2020, you see dramatically higher growth percentage-wise in the index providers. And if you look at market share, now truth be told, both non-index and index assets went up pretty dramatically over this period, but you see market share changes from about 10% in 2010 to about 20% in 2020. And that's a trend that's even more accentuated in the United States. Depending on how you measure it, in the US, we might be near 50% of assets being passive or passive in nature and how they're done. Okay, so we've got this trend in the same direction. This makes things difficult. As an empiricist, is there a way to untangle these issues? Well, so let me take you on a little diversion. Okay, you've heard a lot about MIFID II and dark pools and a lot of these are very important issues, but think for a minute, put yourself in a different setting. Imagine yourself as a scientist or researcher, and you see an important question. This important question is an observation, right? Parents with high rates of cancer have children with high rates of cancer. Okay, now there's two very plausible explanations that probably jump out at you. One is it could be genetic, right? These parents, these children, they share the same genes. Perhaps that increased probability of the children getting cancer is genetic in nature and it's passed from parents to children. Okay, now the problem is because parents and children often live in the same house or when they grow up, same neighborhood, city, location, it could be the environment as well, perhaps secondhand smoke in the home or pollution, depending on how you think about it or what type of cancer. Now, how do I tease out these two things? How could we possibly distinguish between the two? Well, it turns out the medical establishment, these medical researchers, this was in 2000, so they've been using this trick for a long time, have taken this notion of twins. Okay, so I have a picture here of Mary Kate and Ashley, who when I was much younger, so I was 9 or 10, they were some of my favorite twins, as it were. I can't say they were actually in the study per se, but this New England Journal of Medicine study in 2000 said, okay, let's take a bunch of twins, monozygotic and dizygotic, right? So what is that? Well, identical twins who have 100% shared genes and dizygotic that do not, right? So if I've got variation in, I think of it as a treatment and control and the genes and the environment, I'm much better able to tease out between these two twins what really is driving at the end of the day the relationship between parents, genetics and the children and the environment, right? Is it genetics, is it environment? So using these twins, right, that vary in how much genetic overlap they have, but with holding the environment constant, this study finds out that 42% of the risk for prostate cancer is due to genetics, 35% for colorectal cancer, 27% for breast cancer. Okay, now, fair enough. And you're probably wondering at this point, why am I talking about this? What in the world does it have to do with this issue? Now, remember the problem that we've got here, right? The ideal scenario is I really want the exact same fund in the EU, one of which, it's almost like if you split the sample of EU funds and allowed half of them to bundle and half not to bundle, then I'd have a twin sample, right? I have a treatment and a control, and I could compare both of them. Both of them would be subject to these competitive pressures from passive or whatever effects you think might be going on in the market over that time period. The question is, do mutual funds have twins? It turns out they do. So consider Janus Henderson investors, right? So Doug Rao and Nick Schomer have been managing the Janus 40 fund for many years now. Okay, now what is the Janus 40 fund? So you can see here, JFRDX is the ticker for the US version of this fund, and it's a concentrated equity fund. This is share class D. It turns out they sell the same product in Europe as well, right? So same manager, same fund, different pools of capital. And here you can see the European share class, and it's sold a variety of different ways in Europe, but this is the euro denominated cross Europe sales component of this 40 fund. Anyway, so we've got the 40 fund and the US 40 fund, right? So an EU and a US twin, same managers, same investment advisors, experiencing very similar pressures. The question is, could we use twins in this setting to try and get around these empirical or econometric difficulties? Okay, so that's exactly what Juan Pedro and I are trying to do in this paper, bundle up the winter of MIFID II discontent. Now, I have to caution you here that this is very preliminary, right? Now, why is it very preliminary? It's preliminary because the pandemic happened. So last fall, I was supposed to be in Madrid, hanging out with Udald and Juan Pedro. We were going to make massive progress on this. Instead, I have been in my office doing Zoom to my students, and basically I haven't left this chair in about 1 year and 3 months. So that has hindered our research productivity. At the same time, our initial results, I think, are compelling and interesting. And I think the framework is the right one to try and address this question. Okay, so what do we do? Hold on one second. There we go. Okay, so if we want to estimate the impact of MIFID II on performance, it requires 3 things. One, being able to isolate the cost of bundled research. Okay, so what is the cost of bundled research? How much is there? So both the amount and how much exists. We need to isolate that, which, as you saw before, is tricky because basically almost all firms just went ahead and they're subtracting it from P&L. Okay, so we don't have much cross-sectional variation there. Okay, now it would be nice too to measure performance independent of this cost, to take those bundled commissions one place and compare them to performance a different place. So performance isn't convoluted and affected by the bundled costs themselves. And lastly, a treatment and control setup where both funds, or treatment or control, or twins as it were, are subject to the same external market conditions. For example, this passive competition or other ones that you might imagine are really affecting markets at this time. Okay, so our approach is to use these twin US EU funds with the same manager, investment objective, investment advisor. We're going to use it to examine the potential shift of bundled commissions to US twins. The idea being is this fund operates in both places. It can no longer bundle them in the EU version of it, but it still can bundle in the US version. So do we see a shock to those bundled commissions over time? The answer is yes. I'll show you that data. Okay, that's the first step. The second step is then to take that estimate of bundled commissions from the US fund and compare it to performance of the EU fund. Remember, it's the same managers. So whatever they learn from those bundled commissions from the US bundling, that same information could be applied and should affect their decision-making with regard to the EU version of the fund. So we've got a control sample of EU funds with no US twins and another control that I'll talk about in just a minute. Okay, so that's sort of the setup. That's where how to try to address these things. That's where we're going to get our twin and our treatment and our control, as it were, at the end of the day. Now, it's important in that not all twins are alike. So there's this great movie, I think from the late 80s, called Twins with Schwarzenegger and DeVito. And if you haven't seen the movie, you should. It's maybe the single best Arnold Schwarzenegger film ever. And some of you are probably thinking that's not a very high bar, but okay, it's a relative statement. At the same time, it's a useful movie. You should see. So in this movie, Schwarzenegger and DeVito are twins. Now you look at that picture and think, how in the world are they twins? Well, not all twins are alike. And one concern with our framework here is if we compare EU funds with twins and those without twins, we're basically sorting on advisory firms. All right, so those with twins are more likely to be much bigger, have bigger analyst and manager pool, overall resources, et cetera. That's a concern. So one thing we're going to do is we're going to repeat the analysis on a subsample of these EU funds that have twins, but whose twins do not bundle research. Okay, so you've got a twin in the US, so you should be similar in terms of advisory firm, but that twin in the US indicates in their regulatory filing, so NSAR initially, later the NCEN is the second filing, that they do not bundle their commissions with research. Okay, so there you've got, slightly better twins, as it were. Now, in the first case, we're going to try and control on the right-hand side for these other effects. How big is the investment advisor? How many funds they operate, et cetera, et cetera. Okay, so these initial results. So looking at the bundling, we're going to look here at the brokerage commission rate. That's our dependent variable. So that's brokerage commissions divided by the purchases and sales. And here we're focused on the US sample. And the question is, okay, you've got, a US twin for this EU fund. Do we see post-MIFID an increase in this brokerage commission rate consistent with directing more brokerage towards those, more of your trades towards those brokerage firms that would bundle research as well? And so what do we find? We find strong, positive, statistically and economically significant evidence that yes, the US twins seem to have an increase post-MIFID in this brokerage commission rate. Right now, it turns out if you look at the purchases and sales, they don't seem to change quite as much. They go up a little bit. It's more that the rate that's being paid, controlling for all these other things, seems to increase just for those funds that have an EU twin. Now, once again, you had the same concern about the previous setup for our twins. You say, oh, look, US funds with an EU twin are different than US funds without an EU twin. Well, we can also do it for the subsample of funds that all have twins, but some of which bundle and some of which don't. And what we see here, that positive coefficient suggests that this is being driven by those twin funds whose US twin does bundle their research with their commissions. It's not being driven. In fact, we find no effect in those US funds that do not bundle, that have a twin but do not bundle their research with their commissions. Okay, so fair enough. There's bundling here. We can isolate that bundling and the cost of that bundling, as it were, and then examine how that impacts performance on the EU fund, right? So now we've got two EU funds, one that can, has access to this bundled information, research from its US twin, the other one does not. How does that affect performance? Now here, I'll be honest, I'm looking at a benchmark alpha. Now, my academic colleagues would suggest there's lots of ways to measure performance. We often use these factor and multi-factor models to pull out systematic returns. I've started with, and I focused first here on benchmark alpha, because in my mind, that's probably the most likely measure of performance for the underlying investors, right? If they're going to look at an alpha of any variety, they're probably not calculating a 1-factor, a 3-factor, a 4-factor alpha. They're probably looking at a simpler measure of performance relative to the benchmark or performance relative to peer group. And I've got a couple of other published papers that strongly suggest that's true, at least for US investors. And I wouldn't be surprised if that was true for EU investors as well. So the caveat is there's other ways to calculate performance. As robustness, we should check there as well. At the same time, we don't find it's not that we find a small positive effect. We find no effect at all. And if anything, although it's statistically not different from zero, that point estimate is negative, right? Now, as a statistician, I should never say that. What we find is no effect at the end of the day. But I was surprised that even the coefficient's negative, as it were. So what do we find, right? Overall, this study, and it's very preliminary, suggests, look, there's a really important question here. So what's going on with MIFID II and bundling of commissions and not allowing that bundling is an important question for regulators all over the world. I'm certain the SEC regulators are looking carefully at this and its impacts both on investors and market efficiency. Think of information production, in particular for those small and mid-sized firms. At the same time, there's compelling economic arguments in favor and against. I don't think that was the case with distribution. I think it is much more the case with bundling research. So what do? Well, we try and address this tricky econometric statistical quagmire by using a sample of these twin funds. We find post-MIFID II implementation, US twins bundling increases. So it looks like the twin now is increasing how much research they're buying via their commissions. And this increased access to bundled research relative to a control group has no significant effect on performance. Okay, now, I don't want to say that's the end all. There's much work to do, but in my mind, this is a promising start. And I hope an important way to think about this problem and how to answer this problem, which I think matters tremendously for regulators, for practitioners, and definitely for investors at the end of the day.
Okay, thank you very much, Rich. This has been an amazing, brilliant, entertaining speech. So entertaining and so brilliant that I think you have left the audience speechless because I don't have any questions for you, to be honest. I myself, funny enough, I'm an identical twin, so I've listened to your speech with a lot of interest because I'm aware of how much research is done using identical and non-identical twins. But I have to say that in the case of your conference, this has not led me to the point of asking any questions because basically you have put the questions and answered them all. So I don't know.
Nothing wrong with that. That's quite all right. I think, like I said, really interesting topic, and I think this is an interesting way to approach it and try and get at it. So, but yeah. I understand it's been a long conference, lots of very interesting things, and I'm totally fine if we leave it at that. All is well.
And it is just the first day. So, and we are having you tomorrow again. So it's amazing how generous you are being with your time and we have abusing your patience, but it's been so good today that we are looking forward to having you here with us tomorrow at the last panel. Well, since I don't see any questions, I just want to thank everybody for well, first of all, speakers, discussants, Rich, everybody, all our technical staff who has done great work to letting us have this conference without any incidents. And above all of you, the audience, for your interest. We appreciate your having been with us tomorrow and encourage you to be with us tomorrow again for the second part of the conference, with which Richard has built a bridge from one to the other, because it's basically the topic tomorrow will be on almost all these things. So thank you very much again, and see you all tomorrow. Bye.